Good morning, everyone, and welcome to today's class, which is called Reporting Capital Gains and Losses. I've just got the student manual up on the screen in front of you, and we are going to begin on page 2 of the manual with the introduction. And capital gains are a very important topic for tax preparers to understand well. A lot of the time it's the case that the rules on capital gains are rather mystifying to tax preparers. I frequently talk about the Oregon Consultant and Preparer exams because we're the only state that has them, and there's some relevant information that I can always reflect back to them on. And one of the interesting things about the Oregon LTC exam, which is an exam taken by tax professionals who have a minimum of 1,100 hours of work experience over a 2-year period and who have already also passed an 80-hour basic tax course and worked as an apprentice for a 2-year period and passed a tax preparer exam on basic tax law. And the Oregon Tax Board does it as well for the basic preparer exam. But on both exams, it breaks down the subjects being tested and what weight of the exam is going to be given to a particular topic. What's interesting about the consultant exam is the absolute weight it gives to the topic of capital gains and losses. Fully 40%, I believe, of Part 2 of the test. So the consultant exam is a 2-part test, and I believe 40% of Part 2 is devoted to capital gains and losses because they really, really want you to get this topic. So way back in the mid-90s when I was studying to take the LTC exam, that was when I had to bone up on and really get to understand capital gains and losses. And I spent a good amount of time studying and really starting to understand these topics. And for me, at that point, a light came on. I went from the foggy, hazy world of understanding a little bit about tax law, perhaps enough to get myself into trouble, but also being rather confused on a number of things. So I'm hoping that by the end of today's class, there'll be a number of things that are much clearer to you. And if you're still foggy after I've taught the class today, then what I recommend you do is spend some time working your way through the various classwork assignments, homework assignments, quiz questions that we give with this course, because those are the types of things that cause deep reflection and more intense study. There's also the reading assignment for today's course, and the topics covered in today's class. Some of it comes from Pub 17, but a larger part, the more specific, complex information is coming from publication 544, Sales and Other Dispositions of Assets. And that would be a publication I would put on my list of things you should read. I have publication 946 on the list of publications you should read. Well, this is another one. So let's move on then with the introduction, beginning on page 2 of the course. And different rules apply to the sale of capital and non-capital assets. Gains and losses on the disposition of personal investment property are taxed differently than gains and losses on the sale of business property. This course covers reporting requirements for dispositions of assets on Schedule D in Form 8949, and the sale of business property is covered in our 1040 CPE series course called Sale of Business Assets, and I'll actually be teaching that class this afternoon. So let's talk about sales and trades first. In order to know whether you have a taxable sale, you must first determine the nature of the property that you are selling and whether you have a gain or a loss. In general, you do not need to report the sale of personal property that you sell at a loss, and this is because the loss is not deductible to you. However, if you sell your personal property for a profit, or if you sold investment property, then you do not need to report your sale. A sale is generally a transfer of property for money or a promise to pay money in the form of a mortgage or note. And a trade is a transfer of property for other property. If you sell property for money and then immediately use that money to purchase replacement property, you do not have a trade. Capital gains and losses. And generally, you will have a capital gain or loss if you sell or exchange a capital asset. So let's look now at the character of the gain or loss, because in order to determine how you are supposed to report the sale of a property, you need to be able to classify that gain or loss as either ordinary or capital. And in fact, today's classes, there are 2 of them. There is reporting capital gains and losses, which I'm teaching right now. And then this afternoon, there's another class called Sale of Business Property. The difference between these 2 courses is all about this key point right here. Is the sale ordinary or is it capital? Because if it's capital, it belongs on Schedule D and Form 8949. And if it's ordinary, it belongs on Form 4797. So today we're focusing in the morning on Schedule D and 8949, and then in the afternoon we'll look more at ordinary. But just to give you an idea of what the difference is between ordinary and capital, let's look at what is an ordinary gain. And an ordinary gain results from the sale of non-capital assets, such as property held mainly for sale to customers, also known as inventory. Depreciable property used in a trade or business. Real property used in a trade or business. A copyright, a literary, musical, or artistic composition, a letter or memorandum, or similar property such as drafts of speeches, recordings, transcripts, manuscripts, drawings, or photographs that were created by your personal efforts, prepared or produced for you in the case of a letter, memorandum, or similar property, or received from a person who created the property or for whom the property was prepared under circumstances, for example by gift, entitling you to the basis of the person who created the property or for whom it was prepared or produced. Note, though, that you can elect to treat musical compositions and copyrights in musical works as capital assets when you sell them or exchange them if your personal efforts created the property or you acquired the property under circumstances, for example by gift, entitling you to the basis of the person who created the property or for whom it was prepared or produced. Now, if you wish to make this election, you must make a separate election for each musical composition or copyright in a musical work that is sold or exchanged during the tax year. You must make the election on or before the due date, including extensions of the income tax return for the year of the sale or exchange. You must make the election on Schedule D and Form 8949, Form 1040, by treating the sale or exchange as the sale or exchange of a capital asset according to the Schedule D and its instructions. Now, this particular rule about being allowed to treat as a capital gain the product of your own labor is unique and special and applies to only one category of work product, and that is musical compositions or copyrights in those musical works. So, for example, if you're a painter and you created a painting, you would not be able to make the same election for that painting. It's only for musical compositions. Another form of ordinary gain property or non-capital gain property is accounts or notes receivable, supplies of a business that you regularly use or consume in the ordinary course of your trade or business. So those are all, these bullet points right here, examples of products or assets that would sell for ordinary gains. And let's compare those to the type of assets that would be sold and reported as capital gains. They include stocks or bonds held in your personal account, a house owned and used by you and your family, household furnishings, a car used for pleasure or commuting, coin, stamp, or jewelry collections, gems and jewelry, gold, silver, or any other metal, and timber grown on your home property or investment property, even if you make casual sales of the timber. This one's an interesting one. If you live in tree territory where the tree business is big, even if you live in an area where the tree business isn't big, it's not uncommon to run across people who have acreage land, and on this land they have trees. And at some point the decision may be made that there is marketable timber on this land, and decision is made to cut the trees down and sell them for cash. And there is this timber tax form that you may have heard of floating around out there, and the instinct might be, oh, I've just sold timber, I need to run out and fill out this timber T form. And in fact, that's not the case. The timber form is really reserved for people who are in the business of commercial harvesting of timber. It is not for the casual sale of timber if you just happen to be an individual who has timber on your land and you sell it. And if that is you and you sell the timber on your land, it's actually a capital gain and reported as such. So let's move on now to holding period. If you sold or traded investment property, you must determine your holding period for the property. And your holding period determines whether any capital gain or loss was short-term or long-term as follows. For a short-term gain or loss, to have that kind of gain or loss that is short-term, you must have held investment property for 1 year or less. And for long-term, you must have held your investment property for more than 1 year. And this is really crucial here. You are not long-term if you held the property for exactly a year, because a year is not more than a year. So if you hold property for a year, that is not long-term, that is short-term, because you must have held it for more than a year for it to be long-term. Now, determine how long you held the property Begin counting on the date after the day you acquire the property. The day after you dispose of the property is part of your holding period. And here is an illustration. You bought an asset on June 18, 2013, and you start counting on June 19, 2013. If you then sell the asset 1 year later on June 18, 2014, your holding period is not more than 1 year. If you sold the asset on June 19, 2014, then your holding period is more than 1 year. If you bought or sold through the stock market, your holding period begins the day after the trade date that you bought the securities and ends on the trade date you sold them. You should note, however, do not confuse the trade date with the settlement date, which is the date by which the stock must be delivered and payment must be made. You should report any gain or loss in 2014 for any sale with a trade date beginning in 2014, even if the settlement date for the sale was at the beginning of 2015. Stock dividends. If you received taxable dividends in the form of stock, essentially a dividend reinvestment, then your holding period begins on the date of the dividend distribution. If you received a non-taxable dividend in the form of a stock split or a spin-off, your holding period is the same as for the original stock. So let's think about this for a second. You own stock in ABC Company, and ABC Company goes through a split. So instead of having 100 shares in ABC Company, you now own 200 shares in ABC Company. The holding period for all 200 shares is the same as it is for the original 100 shares. Another option would be ABC Company spins off and creates EDH Company. EDH Company is going to have the same holding period for you as the original ABC Company because one created the other. But on the other hand, let's just suppose your stock in ABC Company issues to you on April 30th, 2014, a dividend distribution of $100, and you use that $100 to buy another share of ABC Company. Well, now you're going to have varying holding dates for your ABC stock. Your first original shares of ABC stock are going to have the original purchase date, but the share or shares purchased with that $100 dividend distribution are going to have a new holding period that begins on the date that that distribution occurred. Let's move on now to non-taxable trades. If you received property in a trade, your holding period for the new property begins on the day after you originally acquired the old property that you traded away. Property received as a gift. Your holding period for property you receive as a gift depends on your basis. If your basis is the giver's adjusted basis, then your holding period starts on the same day as the giver's holding period. But if your basis is the fair market value, then your holding period starts on the day after the date of the gift. Inherited property. If you inherited property, your holding period is always long-term. When reporting a sale of inherited property, you should enter inherit on Form 8949 or Form 4797 for business property as the acquisition date. So this is one that often gets people. They don't think about whether stock was inherited. And very often it is the case that a person comes to hold stock through a bequeathment. And it very often will come up in the conversation as to when they took ownership of stock. And if you have a client who says, yeah, I'm making an appointment to come in to see you, let's suppose this is a new client. They've never been to a tax preparer before, and the reason they're coming to see the tax preparer is because they've inherited some property, and they don't know what to do about it. Well, the second you have any inkling that property was inherited, your mind should be thinking, okay, have basis adjustments been done on the 1099-B? Have any basis adjustments been done for any other physical assets that may have been inherited, for example, a business or real estate? For example, the home that if your parents died, there's their home, and you've inherited the home. So your holding period for inherited property is always long-term, and when you indicate that you have sold inherited property, the date acquired, you should write the word inherit instead of the actual date. The date that the person died is not entered here. The date that the person who died purchased the stock is not entered here. Rather, you just write the word inherit, and then it will always be long-term. Next, how to figure gain or loss on the sale of property. To calculate your gain or your profit or loss on the sale or trade of property, you must first calculate the following: your adjusted basis in the property and the amount you realized from the sale. Let's talk about adjusted basis in the property you sold. Your adjusted basis is your original cost basis in the property plus and minus certain adjustment items. And one exception to that rule would be inherited property, because with inherited property, as we discussed in my course last week on basis of assets, inherited property, your basis in inherited property is nearly always going to be the fair market value on the date of death. It may be other numbers, but that's kind of the baseline point that you should start from until you've established that it isn't some other amount. It will nearly always be the fair market value on the date of death. Amount realized from the sale. The amount you realized from a sale is everything you received for the property, including cash, notes, or mortgages payable to you, mortgages or other debts owed by you and assumed by the buyer, other property or services you receive in exchange for your property. Seller financing. If you finance the sale of property, the amount you realize is the total of all payments you receive over the lifetime of the loan minus interest. And this is because all loans are treated as having two components, interest and principal. If your loan does not state the rate of interest that applies, then the IRS will apply a minimum rate of interest to the sale. And here is an illustration where sales proceeds must be allocated between principal and interest. You sell your renter home under a contract sale on January 1, 2013. The sales price is $150,000, and the buyer pays you $10,000 down and agrees to pay you the remaining $140,000 within the next 18 months. On January 1, 2014, the buyer pays you $140,000. There is no stated interest amount for this transaction. Even though the interest was not stated, we must construe that the interest was paid. You must allocate a portion of the sales proceeds to the interest at a fair market rate. If the fair market rate for this transaction is 8% a year, and that would be a really high number in today's times, then you must subtract unstated interest from the sales price. In this example, unstated interest would be $140,000 times 8%, or $11,200. Therefore, the true amount realized on the sale is $10,000, that was the down payment, plus the remaining payments minus interest of $128,800. So your total amount realized on the sale would therefore be $138,800. And the amount of interest you must report on your 2014 return is going to be $11,200. So here we have the total sales payments received in 2014. They totaled $140,000. Of that $11,200 will be reported as interest income and go to Schedule B, and the remaining $138,800 will be reported on 6252 as installment sale income, and then we'll carry to the Schedule D. I do have a question for those of you in the audience. Why do you think this is a rule? Why do we have to assume that there is interest in this loan? Why would the IRS have that rule? You can go ahead and chat me what your thoughts on the topic are. Capital gains, the topic of today's class, is a very special category of income. Capital gains is given special treatment. So it's given special treatment under the tax code, whereas ordinary income gets ordinary treatment, right? And what kind of income is interest income? So interest income is, of course, ordinary income. And the profit or capital gain on the sale of a piece of real estate is going to be capital gain income. Capital gain income is taxed at a maximum rate of anywhere from 0 to 28%, depending on the type of property you sold, whereas interest income is going to be taxed at whatever tax bracket you happen to be in, which could be as high as 39.6%. So there's definitely an incentive for someone want to give an interest-free loan, and that's precisely why IRS says, no, you're not going to inflate or increase the sales price so that you can then engage in an installment sale and disguise interest as capital gains over a period of time. There's another reason, I think, why this rule is in place, and it has to do with gift laws. Under IRS rules, if you give property away, and there's a limit you're allowed to do each year before you have to file a return on it, it's roughly $14,000 a year that you're allowed to gift to an individual, and no tax consequence comes from that. But if you gift more than that annual threshold amount to an individual, now you are required to file a gift return. And it gets into the estate tax laws and the gift tax laws that we have these rules. So again, if you give an interest-free loan to someone, there could be an incentive, really, say if you sold a very valuable piece of property to your child. Let's say you're a very wealthy individual and you have a business worth several $1 million and you decide you're going to sell the business to your child at 0% rate of interest, right? There would be an incentive there to do that, but the IRS is going to say no because there should be a huge amount of interest assessed on that kind of a loan, and if you give that much money to your child, then that would fall under the gift rules. So those are two key reasons, I think, why IRS has this gift rule in place, or not gift rule in place, but this rule where you must construe a minimum rate of interest. So let's move on to the next topic, which is treatment of capital gains. If your capital losses are more than your capital gains, you can deduct your allowable losses against your taxable income. The yearly limit on the amount of capital loss that you can deduct is $3,000, or $1,500 if you are married filing separately. Let's look at the rules for what happens when you have a loss that's too large to be allowed. And if you do, then you get to carry it forward. So your capital loss carry forward amount is going to be any amount of loss that exceeds the limit for the year. And the limit for the year, generally $3,000 if you are single, or actually any filing status except married filing separately, or $1,500 if you are married filing separate. So if your losses are more than that annual limit for your filing status, then you generally carry your loss forward to the next year. So now let's look at another rule that we have to remember, and that is differentiating between short-term and long-term loss carryforwards. When you carry over a loss, it retains its original character as either long-term or short-term. A short-term carryover to the next tax year is added to short-term losses that occur in that year. And a long-term loss carryover to the next year is added to long-term losses occurring in that year. If you have both short-term and long-term losses, your short-term losses are used first against your allowable capital loss deduction. And if after using your short-term losses you have not yet reached the limit on the capital loss deduction, then you can use your long-term losses until you reach the limit. So let's look at an illustration I made here to show how these limits work. In this illustration, we have a carry forward of short-term and long-term losses. In 2012, you had short-term losses of $6,000 and long-term losses of $8,000 on stock that you sold. Total losses reported on line 16 of Schedule D, this line right here, were $14,000 for the year. We know that of that $14,000 loss, only $3,000 is going to be allowed on the tax return, assuming the filing status is not married filing separate, and we're going to say the filing status is single. So $3,000 will be allowed. And we can see right here that we're going to allow a $3,000 loss out of $14,000. That means we have an $11,000 carry forward. But what is the makeup of the carry forward? Well, the reality is that short-term losses are always going to be used first. And that means that of the $3,000 loss allowed, all $3,000 is going to be short-term. That means the carry forward is going to be $8,000 long-term and $3,000 short-term. So you can see here, short-term loss is $6,000, long-term loss is $8,000. We're going to allow a $3,000 loss this year off of $6,000. That means the carry-forward short-term is going to be $3,000, and the carry-forward long-term is going to be $8,000. And looking at the front page of the 1040, the loss that is allowed on line 13 is going to be all short-term. We're moving forward now to 2013, and in 2013 you report short-term gains of $2,000 and long-term gains of $3,000. Subtract your short-term gain from your short-term loss carry-forward. So if you have short-term gains of $2,000 and your carry-forward is $3,000, then that means you've got a $1,000 short-term loss that is going to be claimed in 2013. After you've done that, you move over and subtract your long-term gain from your long-term loss carryover. So if the long-term gain is $3,000 and the long-term loss carryover is $8,000, we've got a net loss of $5,000 for the year. The combined total losses for the year are $6,000. $1,000 plus $5,000 is a $6,000 loss. And we know that out of these losses, the short-term loss is going to be used first. And after we've used up the short-term loss of $1,000, we're going to be allowed to use $2,000 of long-term loss. So the total losses allowed on the return for the year are going to be $3,000, of which $1,000 is short-term and $2,000 is long-term. And that leaves, if you take $2,000 from the $5,000 net loss for long-term, that leaves you a $3,000 carry-forward long-term till the next year. So going into 2014, we have 0 short-term carry-forward, and we have $3,000 long-term carry-forward. We move into 2014, and this time you report short-term gains of $4,000 and long-term gains of $10,000. Well, your short-term gains are taxed in full at $4,000. That $3,000 long-term loss carry forward, you don't get to apply it to the short-term gains. It would be nice if you could, because then you'd be offsetting ordinary income amounts with long-term carryover amounts, but that's exactly why the IRS doesn't allow you to do that. So what you're going to have to do is include $4,000 of short-term gains in your income, but you will be allowed to use the $3,000 long-term loss carry forward against the $10,000 of long-term gain income from 2014. So ultimately, you're going to report on the 2014 return $7,000 of long-term gains and $4,000 of short-term gains for combined gains on line 16 of $11,000. So let's look at the 1040. We can see we've got a total amount of $11,000 carrying. And what's ultimately going to happen is that when we prepare the tax computations for this return, in other words, we get to the point where we're figuring the amount of tax owed, this $7,000 gain that is long-term is going to get capital gain treatment, and this $4,000 of gain that is short-term will get ordinary income treatment. So just as a summary, I've created a table here to kind of walk you through all of these rules again. In 2012, we have short-term loss of $6,000. The allowed loss is $3,000 for the year, and the carryover is $3,000. In 2012, the long-term loss was $8,000. No loss was used in 2012. The short-term loss was allowed in full. So we have an $8,000 long-term loss carryover, and we have a $3,000 short-term loss carryover. Moving into 2013, we had a $2,000 short-term gain, and we're going to offset that with a $3,000 short-term loss carry forward. That leaves us with an allowable short-term loss of $1,000, and then we move over to the long-term. Under long-term, we had a 2012 long-term gain of $3,000, but the long-term carry forward of $8,000 is going to reduce that gain or change that $3,000 gain into a loss of $5,000. Now, we are allowed to start claiming long-term losses when we've used up all of our short-term losses. And in 2013, that happens. We have only $1,000 of short-term loss carry forward, and so that means we will now be allowed $2,000 of long-term loss carry forward for total losses allowed on the 2013 return of $3,000, and a carryover loss long-term to 2014 of $3,000. Then in 2014, we have a $4,000 gain. No short-term loss carry forward to offset it, so the gain for 2014 short-term is $4,000. In 2014, we have a gain of $10,000. We're going to offset by the $3,000 long-term loss carry forward for a total long-term gain of $7,000. We add the $7,000 of long-term to the $4,000 of short-term, and that gives us the capital gain amount, or the amount to report on line 13, is $11,000, and of that $11,000, only the long-term amount of $7,000 gets the capital gain treatment. So how do I figure my capital loss carryover? Well, you can see how I did it. I explained it in the wording, but on each of these illustrations for the preceding 2 years where we had a loss carryover, I completed something called the capital loss carryover worksheet, and I'll zoom in so you can take a closer look at it. This is it right here. And on the capital loss carryover worksheet, you enter the amount of loss that you have, the amount of loss that's being claimed, and the amount of loss that will ultimately carry forward. And you can see on this line, line 8 of the 2013 worksheet, it shows the allowable loss carry forward will be 0 short-term, and for long-term, the allowable loss carry forward shall be $3,000. Death of taxpayer? Sorry, capital losses cannot be carried over after a taxpayer's death. They can only be deducted on the final return, and the yearly limit still applies. Any excess may not be deducted by the decedent's estate. Capital gains and tax rates. The 28%, 33%, and 35% income tax rates for individuals do not apply to a net capital gain. In most cases, the 10%, 15%, and 25% rates do not apply either. Instead, your net capital gain is taxed at the lower capital gain rates. Let's talk about net capital gain. Net capital gain is the gain for the year that is more than the net short-term capital loss for the year, and net capital gains are subject to lower capital gain rates of tax. And here are the rates. For 2014, there are several capital gain rates that apply depending on the date of the sale and the tax bracket of the taxpayer. There are also, or is also, a 20% tax rate that applies to filers with income above $400,000 if single, $450,000 if married filing joint, or $225,000 if married filing separate. So if your net capital gain comes from collectibles, then your maximum capital gain rate is 28%. If your gain comes from an unrecaptured Section 1250 gain, the tax rate is 25%. And I missed a line here. It says eligible gain on qualified small business stock minus the Section 1202 exclusion. It also is taxed at a maximum rate of 28%. And I'm going to give you a little bit more information about that just in these italics here inside the box. You can see there's an asterisk here for Section 1202 exclusion. Lots of people haven't heard of a Section 1202 exclusion, but it's kind of an interesting animal, and here's what we have to say about it. Back in 1993, to help stimulate investments in small business, a law was introduced under Code Section 1202, which states that you may exclude from taxable income up to 50% of the gain you realize on the sale of qualified small business stock acquired after October 10, 1993. The non-excluded portion of the gain on the sale is subject to tax at a 28% rate, resulting in an effective rate of 14%. That is 50 times 28% on the entire gain. The exclusion amount can be up to 75% of the gain for stock acquired after February 17, 2009, and up to 100% for stock acquired after September 27, 2010, and before January 1, 2012. The exclusion can be up to 60% for certain empowerment zone business stocks. Now, the Taxpayer Relief Act of 2012 and the Tax Increase Prevention Act of 2014 extended the 100% exclusion of the gain from the sale of qualifying small business stock that is acquired before January 1, 2015 and held for more than 5 years. The bill also clarifies that in the case of stock acquired after February 17, 2009 and before January 1, 2015, the date of acquisition for purposes of determining the percentage exclusion is the date the holding period for the stock begins. All right, let's move on to the next category of gain that we have, and that is unrecaptured Section 1250 gain. Anybody here know what Section 1250 gain is? Rental depreciation, that's a good one. Rental depreciation would be Section 1250 gain, provided it is what? Nope, not straight line, something else. Something else about rental depreciation is what is important. I'll give you all a hint. It has to do with the fact that it's real estate. And so there are different types of property, and we talk about those in the class this afternoon when I get into the sale of business property. So the sale of a rental property would be the sale of a business use asset. The sale of a commercial building would also be the sale of a business use asset. The sale of a car used for income production in a business would also be the sale of a business use asset, but the sale of the car would not be Section 1250 gain because it would not be real estate. So the Section 1250 gain specifically refers to property held for income production, held more than a year, and sold at a gain. It can be sold at a loss too, but in this case, when we're looking at this 25% rate of gain, the 25% rate of gain is going to apply to any recovery of depreciation. So let's suppose you sold an apartment complex for $1 million, and you held the apartment complex for a period of time and previously claimed $100,000 of depreciation on it, and your original acquisition cost of the property was $800,000. Well, if you look at the difference between the acquisition cost of the property, $800,000, and the sales price of $1 million, you've got a $200,000 profit, and it would be categorized as capital gain. But you also have $100,000 of recovery depreciation, and that recovery depreciation is called unrecaptured Section 1250 gain, and it will be taxed at a maximum rate of 25%. So on the total $300,000 gain on that property, you have $100,000 taxed at 25% maximum rate and $200,000 taxed at a maximum rate of either 0%, 15%, or 25%, depending on the income level of the person to whom that income belongs. So let's look at the other kinds of capital gain categories. We have other gain, and the regular tax rate that would apply is 39.6%. Other gain and your regular tax rate that would apply is 25%, 28%, 33%, or 35%. is a maximum rate of 15%, and other gain and your regular tax rate that would apply is 10 or 15%. So on that commercial building, if we have $200,000 of capital gain, what rate of tax you pay on it is going to depend on what tax bracket you're in. If you're in the maximum 39.6% tax bracket, then the maximum amount of tax you would have to pay on the $200,000 of capital gain would be 20%. But if your income is actually lower than that, that is 25, 28, 33, or 35%, then the maximum rate that it would apply is 15%. And if your income tax bracket is 10% or 15%, then the maximum capital gain rate that it would apply is 0%. Qualified dividends. If you received qualified dividends, your dividends qualify to be taxed at the 0%, 15%, or 20% capital gain rates instead of ordinary income rates. Qualifying dividends and the holding period. To qualify, a dividend must be received on a stock held for more than 60 days in the 121-day period, beginning 60 days before the ex-dividend date. Report qualified dividends on Form 1040, line 9A and 9B, and then use the Schedule D or the Qualified Dividends and Capital Gain Tax Worksheet, whichever applies, to figure the tax. There is an exception to this 121-day period where 60 days before and 60 days after, in that it will increase to 90 days in a 181-day period if the dividends were issued on preferred stock rather than common stock. So let's make some sense out of what this is saying. What it's saying is if you purchase stock and then you receive dividends from that stock, those dividends from that stock will get the lower capital gain rate of tax, but only if you've held the stock at least 30 days before or 30 days after the date that the dividends were issued. And why is that rule in place? Well, it seems kind of logical, actually, when you think about it. There could be an incentive, you see, to purchase stock immediately before a dividend is issued, or to sell stock immediately after dividends have been issued. And if you do that, then you won't get the capital gain treatment. You'll only get ordinary income treatment. Qualifying dividends are not included in investment income. If you paid margin interest or other investment interest expense during the year, your investment interest deduction is limited to your investment income. In general, qualified dividends are excluded from investment income. However, you may elect to treat qualified dividends as investment income on Form 4952, line 4G. And here is an illustration of how we're going to figure capital gain rate on qualified dividend income. James had $43,000 of wage income for the year. He received a 1099 DIV reporting $5,000 of dividend income in Box 1A and $4,500 of qualified dividend income reported in Box 1B of the 1099 DIV. His Form 1040 is shown below. Figure his tax using the qualified dividend and capital gains worksheet as shown next. So let's zoom in a little. We're looking at his 1040 return. We can see that he has $43,000 of wage income, and he has $5,000 of dividend income, pushing his total income up to $48,000. On line 9B, we show $4,500 of qualified dividend. And this qualified dividend amount right here is important, because when I see that, I know that I now need to apply capital gain rates to the taxation of $4,500 out of $5,000. So another way of looking at this is that we have $43,000 plus another $500 of ordinary income, and we have another $4,500 of capital gain income. So we move over to page 2 of this taxpayer's return, and we can see on page 2 we've arrived at taxable income on line 43 of $37,850, and we've got tax of $4,696. Now, normally, if you were to look up the tax on a filer like this, you would go to the tax rate tables in Pub 17, flip through them until you find the filing status of the taxpayer, the taxable income amount of the taxpayer, and you'll find a number on the line. And that number you see on the line would be the amount of tax you enter on the return for this tax filer. But whenever you're dealing with capital gain income, you have to throw that table out. Well, you don't throw it out. It is still part of your computations. But you no longer can use only the tax tables. Now you must also complete a worksheet, and that's what I'm going to show you next. So the tax tables, if you were to look up the tax on $37,850, you are not going to get $4,696. You're going to get a different number. So moving over to the next page, of the manual, the starting point is going to be the taxable income from the 1040 return. And for this taxpayer, it was $37,850. All right. Now, on line 2, we enter the amount of income that is dividend income, $4,500. And that dividend income is subtracted from the total income to get $33,350. We get $43,000 plus $500, then we subtract out $6,200, then $39,50, and that would give us $33,350. But the whole point, we're trying to get at this $33,350 to determine whether the income is above or less than the amount for this filer's filing status. And the amount for this filer's filing status is $36,900 because this filer is single. Well, why did we care about that? The significance of $36,900 for a single person is that that is the income threshold where that person moves from the 15% bracket into the 25% bracket. And as long as the individual's income is less than $36,900, then their capital gain income is taxed at 0%. So where does that put this guy? Well, his income, after we subtract out the qualified dividends, is $33,350, and that's less than $36,900. So the next step is to take the $33,350, subtract it from the $36,900, and when you do that, you get $3,550. $3,550 is the amount of qualified dividend income he has on which he will pay 0% tax. And then the difference between $3,550 and the actual amount of qualified dividends he has of $4,500 is $950. And the $950 is going to get taxed at 15%. The next number on the form is $406,750, and the significance of that number is that's the point where an individual moves into the 39.6% bracket. And if our filer was in the 39.6% bracket, then his capital gain and qualified dividend income would be taxed at 20%. But in this illustration, our filer isn't close to the 39.6% bracket, so we don't worry about this factoring here. We simply go back down to this $950 of income that will be taxed at a rate of 15%, and we multiply $950 by 15%, and we get $143. We enter that on line 20. The next step is to determine how much income tax is owed on the non-capital gain type income. And when we figure that out, we have another amount of income, which is $45.53, is the amount of tax on all of the other income that he has for the year that is non-capital gain income, this $33,350. When we figure the tax on that from the tax tables, we get $45.53, and we're going to add $143 to that, and when we do that, we get $46.96. And the final step is to go to the tax tables and look up the tax on $37,850. And when you do that, you get $53.25. So by applying the capital gain rates to this particular filer, we're reducing the tax quite significantly, because instead of paying $5,325 of tax, this taxpayer will only have to pay $4,696 of tax. So we are at a good point to take a break in the class before we get on to the next topic. I'm going to be giving you 3 passwords today in this morning's class, so let me give you the first one now. And while we're on break, I'm going to put up some questions from the C exam that you can play around with a little and test your knowledge on, see how much you're paying attention to me. Password number 1 is trigger. T-R-I-G-G-E-R. All right, everyone, welcome back from break. Let's take a look at these C exam questions together. We'll start with question number 1. And I'll let you all see how you voted. Everybody on this one did good. You selected the correct answer. 3 out of 3 respondents selected the correct answer, which is B, $105. So let's read the question together. Don invested in HoHo Mutual Fund by purchasing 100 shares of stock on March 1, 2013. On the first day of every month, the HoHo Fund pays a dividend that Don elected to have reinvested in the HoHo Fund. Don received 5 additional shares each month. On April 15, 2014, Don sold his entire interest of 165 total shares in the HoHo Fund. How many of the HoHo Fund shares sold by Don qualifies for the long-term holding treatment? So we purchased 100 shares in March of 2013. And remember, holding period is more than 1 year if you want to have that long-term treatment. And we look at how many shares of stock he was able to purchase during the year that he held the stock. And the reality is that only stock purchased long enough ago that he held it for more than 1 year is going to qualify for the long-term treatment. And he's essentially got one dividend reinvestment of 5 shares that would have occurred on April 1st of 2013, so that when he sells on April 15 of 2014, that first dividend reinvestment was held long-term, which is why you would add 5 shares of dividend reinvestment to the 100 original shares and get B is the correct answer, 105 shares total that receive that long-term capital gain treatment. And y'all figured that one out just fine. So moving on to the next question, we'll move on to C question number 2. And on this question, nobody could agree. There is a correct answer listed there, and one of you did select the correct answer. The correct answer is D. Let's take a look at this question. Gain or loss on gifted property. In 2012, Paul received a boat as a gift from his father, and at the time of the gift, the boat had a fair market value of $60,000 and an adjusted basis of $80,000 to Paul's father. After Paul received the boat, nothing occurred to affect his basis in the boat. In 2013, Paul sold the boat for $75,000. What is the character of his gain? So this is actually a look back in time. The character of the gain is going to be the same as his father's. So where did he fall? He has a holding period that is going to be the same as his father's. He received the boat as a gift from his father, and then the boat was sold. But the boat had a basis to his father that was higher than the fair market value at the time he received the gift. And then he sold the boat for somewhere between the fair market value of the gift and the cost in the gift. And when you sell somewhere in the middle, you actually have neither a gain nor a loss. So I did a really bad job of explaining that. So let me try again. And we covered this in our last class last week on basis of assets. When you look at gifted property, when you hold gifted property, your basis for reporting a gain is going to be the basis of the person who gave you the boat. And in this case, the basis of the person who gave him the boat was $80,000. So if he sells the boat for less than $80,000, he doesn't have a gain. And for a loss, he's going to go with the fair market value. And the fair market value of the boat on the date of the gift was $60,000. Well, he's not going to be allowed a loss, and he's not going to be taxed on a gain. So he ultimately follows in the middle with neither a gain nor a loss. And that's why D is the correct answer. And one of you did get that one right. This next one, I touched on this question and spent a little bit of time talking about it when we were looking in the table of the different capital gain rates. And this one is a tricky one. One of you got it right, and the correct answer is B, $1,500. On December 2014, or in December of 2014, Angela sold 20 shares of Neely Company stock for $8,000. This was qualified small business stock that she had bought in September 2009. Her basis is $2,000. What is her capital gain? The capital gain is going to be $1,500. So let's show you where we get that bizarre answer from. And this was question number 4, so I've got a note on it for you. This is a 1202 exclusion. And under the Section 1202 exclusion, if you hold the stock for more than 5 years, you can get this special treatment where only some of the stock is even taxed at all. So you're able to exclude a portion of the gain from taxation. So what is the actual gain on the sale? The actual gain on the sale is $6,000. She sold it for $8,000. She paid $2,000. The difference is $6,000. So it would seem logical that 6 would be the correct answer. And if the wording of the problem confuses you, don't get mad at me, because this is how IRS worded it for their C exam. So what they're expecting you to do is determine that because this is qualified small business stock, it's going to qualify for the Section 1202 exclusion. And the next thing you have to pay attention to is when did she actually acquire the stock? And she acquired the stock, I tell you here in the wording of the problem, she sold the shares in December, and she bought them in September 2009. Well, what's relevant about September of 2009? She acquired the stock after February 17, 2009, and before September 27, 2010. So September of 2009 is definitely between those two dates, and if she purchased between those two dates, then she can exclude 75% of her gain. So $6,000 times 75% is $4,500, which means she can exclude $4,500 of gain from taxation, and the remaining gain of $1,500 will be taxed at a maximum rate of 28%, which is why B, $1,500 is the correct answer. So now if you are sitting for the C exam and you get thrown a question like that, you're going to have to pay attention to when the holding period began. Was it 5 years? And is it in that window of time that qualified for 50% exclusion, the window of time that qualifies for 75% exclusion, or the window of time that qualifies for 100% exclusion? And then if you fall in the window that excludes either 50% or 75% of your gain, the remaining gain, and in the case of this problem that was a $1,500 taxable gain, that gain of $1,500 will get taxed at a maximum rate of 28% rather than the lower rates that would apply in other situations. So let's move on now to the next topic, which is reporting gains or losses. And reporting gains or losses involves filling out forms and doing some computations. So that's what we're going to spend our time on now. So how you report a gain or loss depends on the nature of the property you sold and the manner in which you sold it. And this part of the course will discuss how to report the sale of property in a variety of different situations. For personal use property, report the sale of the personal use property on Form 1040 Schedule D and Form 8949. You do not normally need to report the sale of personal property you sold at a loss because your loss is not deductible. However, if you received Form 1099-S, usually given in relation to the sale of land, your home, or a condominium unit, you will need to report the sale on Schedule D and your allowable loss will be zero. In this situation, Schedule D and Form 8949 would be filed for the purposes of showing the IRS that the sale did not result in a taxable gain. If you sold your personal use property for a profit, the gain may be taxable and should be reported on both Schedule D and Form 8949. So I briefly mentioned sale of home, and I figure we should talk a little bit more about it. Now, I have an entire class devoted to nothing other than sale of home, and so I'm not going to spend a lot of time on it here today. But today I'm just going to point out a couple of things to be aware of when you are selling a home and how you report that sale on Form 8949. Generally, if you owned and occupied your main home for 2 of the previous 5 years, and your gain is $250,000 or less, or $500,000 less in the case of a joint return, then you do not need to report the sale of your home on your tax return. However, if you receive Form 1099-S, you're going to need to report the sale of the home on Schedule D and Form 8949 because without filing these forms, the IRS has no way to know that the income reported on the 1099-S is not taxable. You could say, well, I'm excluded from the gain. I don't owe any tax on it, so I don't need to file for it. And that is what the IRS instructions tell you. However, the IRS won't know that the gain is not taxable unless you tell them that it's not taxable. So this is what you do to tell them that the gain is not taxable when you qualify for either the $200,000 or $500,000 amounts as exclusions. Firstly, you'll complete Schedule D sale of home worksheets to determine your cost basis and the amount of gain from the sale. You'll then report the gross proceeds shown in Box 2 of Form 1099-S in Part 2 of Form 8949 with Box F checked. So this is Part 2 of Form 8949. You're going to check Box F, long-term transactions not reported to you on Form 1099-B. Now, 1099-S is a reporting document, but it is not 1099-B. That's why you check Box F. You then will enter the description main home. You'll enter the date you bought it. You'll enter the date you sold it. You'll enter the sales price. You'll enter your adjusted basis in the home. And then in column F, you would write H, and for the code representing exclusion on sale of home, and then the amount of gain that is excludable from taxation is entered in column G, and then finally your taxable gain, if any, which hopefully it's 0, would be entered in column H. You then carry any amounts from Form 8949 to Schedule D, Part 2, and enter them there. 1099-S, proceeds from real estate transactions. This is the form itself, and you will see that it shows the date that the property closed, the proceeds from the sale of the property, the legal address or description of the property. And then down in Part 5, it says buyer's part of real estate tax. It is relevant that if you see a number in that box, you know what to do with it, because you're only allowed to claim a deduction for taxes assessed against you and paid by you. An amount in this box shows the amount of credit you received for taxes that you previously paid. So if you sell your home, and prior to selling your home you had prepaid taxes on it, and now you're getting some of those taxes refunded to you on the sale, which should happen, the taxes that are refunded to you are not going to be deductible by you. And that's why they put that number there, just to remind you of what they are. So here's an illustration of how you would complete Form 8949 to show the sale of home and exclusion on gain. Peter and Betty Pan sold their home for $742,000. They had no selling expenses. Their gain on the sale is $660,000. The Pans are married, filing a joint return and meet the ownership and use tests. They qualify to exclude $500,000 of gain and the remaining gain of $160,000, which is $660 minus $500. Is reported on Schedule D. Form 8949 and Schedule D is completed for the Pans as follows. So we enter on first, we start with the 8949, and on the form we indicate that the sale was for a main home. We indicate the buy date, the sell date, the proceeds from the sale, the original cost. We indicate a code H for the amount of exclusion that is being claimed, and then the amount of the exclusion is entered in column G, and that leaves us with $160,000 taxable gain. These columns carry all the way down, so there's room for all different kinds of sales, but when you finished entering all the sales on this particular part of Form 8949, you total it on line 2. And whatever amount you total on line 2 then carries over to the Schedule D. And in this case, we're going to Part 2, long-term capital gains and losses for assets held more than 1 year. And they're going to be entered on line 10, which is totals for all transactions reported on Form 8949 with box F checked. So these numbers all carry over in like kind to the Schedule D. And then finally, we get over to this taxable amount on line 15, and this amount on line 15 will receive capital gain treatment. It will either be 15% for the Pans, or possibly it could be 20% if they are in the 39.6% or higher bracket. Next, we're going to look at sale of stock. If you sold stocks, bonds, or commodities, you should receive Form 1099-B, proceeds from broker and barter exchange transactions. You are required to report all sales of stocks, bonds, and commodities on Schedule D and Form 8949. Sale of stock is subject to some additional rules that do not apply to the sale of other property, and one of the more important rules to be concerned with is wash sales. A wash sale occurs when you sell stock at a loss and then repurchase the same stock within 30 days prior to or after the sale. Under the rules for wash sales, you may not claim a loss on your sale. The loss on the sale of your old shares adds to your basis in your new shares. And here's an illustration of what we mean. Your basis in XYZ stock is $1,000. You sell XYZ stock for $750, and within 30 days from the sale, you buy the same stock back again for $800. Your basis in ABC stock is $2,000, and you sell ABC stock for $900, and then within 30 days, you purchase ABC stock for $800. So in both these cases, we have a wash sale, and the rules for wash sales say you disallow the loss. Whatever loss you're disallowing, you're going to add it to the cost of the next batch of stock purchased. Some filers are just really good at wash sales. They get a little bit hooked on the buying and selling of stock. I have a few clients like that. I don't know if you do, but over the years I've observed some clients, they get a little bit addicted to this buying and selling business. And they'll go online on their computers and they'll sit there all day long, buy, sell, buy, sell, buy, sell, buy, sell. And so their entire portfolio of transactions for the year is going to be full of wash sales. And this can get horrendously complicated to figure out. Back in the olden days, I used to have to figure every one of these wash sales manually by hand, and it was a nightmare. Today, with the new reporting requirements on Form 1099-B, the brokerage houses are going to let you know what the wash amount is that is going to be part of the loss that will be disallowed, and they actually track how much is being added back into basis. Thank goodness. So let's go back and look at these two illustrations. XYZ stock costs you $1,000. You sell for $750. That means you have a $250,000 loss. You turn around and buy for $800. Your loss will be disallowed. The $250 loss will not be allowed, and it's going to add to your cost in the new stock of $800. For the ABC stock, you pay $2,000. You sell for $900. That's an $1,100 loss. You're not going to be allowed to claim it. You'll add $1,100 to the cost of the new stock, which is $800, and your basis in the new stock will be $800 plus $1,100. Because you bought substantially identical stock, you cannot deduct your XYZ loss of $250 or your ABC loss of $1,100. You must add the disallowed loss to the cost of the new stock to obtain basis of your new stock. Your basis in the new stock is your disallowed loss added to the cost of the new stock. And here we have a table to kind of line it all up for you. XYZ buys for $1,000, sells for $750, then you buy again at $800. $800 in the new stock, add to that the loss not allowed on the old stock to get a new basis in the new stock of $1,050. For ABC stock, you buy for $2,000, sell for $900, then buy again for $800. The loss is $1,100. It's not allowed. You're going to add it to $800, giving you a new basis in the new stock of $1,900. Now, Form 1099-B today provides space for reporting the disallowed loss on a wash sale transaction, and it shows up in Box 1G of the 1099-B. So that's actually what we're going to move on to and talk about now. A Government Accountability Office study done in the past showed that 7 million taxpayers, which is more than one-third of those who sold securities, may have misreported capital gains and losses, and about half of them did so because they misreported their basis. A law aimed at reducing basis reporting errors by taxpayers began phasing in with tax year 2011. The law requires basis reporting on Form 1099-B proceeds from broker and barter transactions for publicly traded securities, and the basis reporting requirements apply to stock purchased after 2010. So essentially 2011 is when we saw the first redesign of Form 1099-B. We also saw a redesign of Schedule D and the introduction of 8949. And each and every year since then, the IRS has spent time thinking about better ways to do things. For 2011, there was a complete redesign of Form 1099-B, but people weren't happy with it, so IRS redesigned it again in 2012. 2012, they seemed relatively satisfied with it because 2013 there weren't any major changes, but for 2014 they decided to muddle it up again, and they completely redesigned the form for 2014. The main purpose of redesigning the form for 2013, though, does make sense. Because what they did for 2014 is they now have the box numbers on the front of the form match the line numbers on the front of Form 8949. So, for example, if you now look at Form 8949, line 1A of Form 8949 is where you enter the description of the stock you sold. And line 1B of 8949 is where you enter the date acquired. Line 1C is where you enter the date sold. So these box numbers on 8949 now match up with the line numbers on 8949. It's not the case for all of the boxes because not all of the boxes have a space on 8949, but where it is possible to line up, they do. And that goes all the way through line 1G even for adjustments. And 1G is used to show the amount of loss not allowed because of a wash sale. So let's take a look at these. 1B, date acquired. 1C, date sold. 1D, proceeds. 1E, cost or other basis. 1F, code if any. And 1G, adjustments. And then we go on to box 2, the type of gain or loss. Is it short-term or is it long-term? And then we move on to box 3. If this box is checked, then the basis was reported to the IRS. Box 4 is for income tax withheld. Typically, you're not going to see income tax withholding on U.S. residents, but if the U.S. resident failed to provide their Social Security number or failed to fill out paperwork correctly with the reporting agency, then the reporting agency can do backup withholding. And in certain cases with non-resident aliens, they're going to do backup withholding anyway. But typically, if you have notified the IRS of your non-resident status, they don't issue a 1099-B in the same way. They do automatic withholding and ultimately issue a 1042-S. So there are some differences for non-resident aliens. But if you've received a 1099-B and there is backup withholding, it's essentially because it's been determined that you're subjected to it. You'd have to look up the instructions for backup withholding to determine why a particular individual has it. The next box we have is box 5. If checked, this is a non-covered security. Well, a covered security is publicly traded stock acquired after 2010, mutual fund shares purchased after 2011, bond options and other securities purchased after 2012. If you have a covered security, then box 3 should be checked and basis should be reported in 1E. If you have a non-covered security that was purchased before these dates, then box 5 would be checked, and even if there is a number for cost basis on the 1099, it was not reported to the IRS. So my observation with reporting agencies is if they are not required to report the basis, they don't. And if they are required to report the basis, then hopefully they will. But I haven't seen 100% compliance. There's probably a few organizations out there in trouble for non-compliance, but there still are a few that I'm seeing that don't have the basis being reported as it should be. Now, also on the basis, I wanted to go down and tell you that there is a new rule for basis reporting that took effect in 2014, and it's a confusing rule, but it is nonetheless the rule. If securities were acquired through the exercise of a compensatory option, the basis has not been adjusted to include any amount related to the option that was reported to you on a Form W-2. What that means is if you are an employee who purchased stock options through your company or employee stock purchase plan shares through your company, and you received these at a discount, then your employer under the law is required to report that discount as wage income to you and report it on your W-2 as income. So if you are an employee and you are allowed to purchase a stock in your company for $85 when the fair market value is $100, then the amount of income that your employer has to add to your W-2 would be $15. And so because you pay tax on that $15, your cost in the share is not $85, it's in fact $100, which is what you would have had to pay if you'd bought it on the open market. So you could say that the $15 spread, which is the difference between what you paid for it and what it's worth, is a gift to you, but it's not a tax-free gift because the employer has to gross up your wages by that amount. Well, as soon as your wages are grossed up, now your cost is grossed up, but what this rule is saying is that the employer that sells you that stock for less than cost is going to have to report to the brokerage firm that your cost is what you paid rather than the grossed up amount. So what you can do is assume, beginning in 2014, that the basis reported on a 1099-B for stock acquired by an employee through an employee stock purchase plan or through non-qualified stock options is going to be wrong, and you're going to have to adjust for that. Now, there are some other rules about basis that are shown here, and you kind of have to read and think about them a little as you go. What is the amount that's going to be reported as cost basis in this box, 1E, of Form 1099-B? Well, if the securities were granted through the exercise of a non-compensatory option granted or acquired on or after January 1, 2014, the basis has been adjusted to reflect your option premium. And if the securities were acquired through the exercise of a non-compensatory option granted or acquired before January 1, 2014, your broker is permitted but not required to adjust the basis to reflect your option premium. Well, non-compensatory options are options that you are able to purchase, and if they are purchased at a discount, then you're not required to include that in income for payroll purposes. And that would refer to qualified incentive stock option plans. They have separate rules with alternative minimum tax, not what we're talking about in today's class. We discussed that in our last class on basis of assets. But for today, paying attention to this particular rule for compensatory options, that means that you're always going to have to be, from 2014 forward, on the lookout for incorrect basis reporting on 1099-Bs. And the reality is that before 2014, it was basically up in the air. They might have the correct basis in there, or they might not have the correct basis. And so you still had to be on top of it and assume that the basis was wrong until you could prove it was right. And now you can work off the assumption that all of the basis reporting is wrong when you're dealing with compensatory stock purchase plans and employee stock options. There was one other box here, which is proceeds from the sale. Box 1D, proceeds from the sale. Proceeds includes cash proceeds reduced by any commissions or transfer taxes related to the sale for transactions involving stocks, debt, commodities, and forward contracts, non-Section 1256 option contracts or securities futures contracts. This box does not include proceeds from regulated futures contracts or Section 1256 option contracts. You report the amount in this box on Form 8949 or on Schedule D, whichever is appropriate. So let's move on now to Box 3. Because I showed you earlier that Box 3, if it's checked, it means that the stock purchased is covered stock, and that means Box 1E should have a number in it, and that number would be the basis. But if it's a non-covered security, that is a security purchased before the dates shown here, depending on the type of stock, then the basis does not have to be reported. And even if the amount of basis is shown on the 1099-B, you would still treat it as a non-covered stock. Box 6, reported to IRS gross proceeds or net proceeds from the exercise of a non-compensatory option resulting in a sale of a security, and indicates whether the amount in Box 1 was adjusted for the premium. All right, so moving on down, there's one other box to point out, which is Box 13. That is where you report income from barter transactions. And, of course, if you have a transaction that is a barter transaction, it's still reportable. And then moving on now to Form 8949, we're going to take a look at how the form is completed, the instructions for filling out the form itself. Most sales of property are not reported directly on Schedule D. Instead, another form is filled out and then carries to the Schedule D. Form 8949 is used to report sales and exchanges of capital assets. The form allows you to reconcile amounts that were reported on Form 1099-B or Form 1099-S with amounts that you report on your tax return. Form 8949 reporting rules. Form 8949 is used to reconcile amounts reported to the IRS with amounts reported on your tax return, and therefore it is important to match entries on Form 8949 to the amounts reported to IRS on Forms 1099-B and 1099-S. So just finished showing you how the boxes on the 1099-B are going to correlate to the line numbers on the 8949. And here we're looking at Part 1 of Form 8949, and we're going to check box A, B, or C. Down below we have Part 2 of Form 8949 with boxes D, E, and F. All right? And in both cases we have line 1. So it's line 1 box D, line 1 box E, line 1 box F. Or up here under short term we have line 1 box A, line 1 box B, or line 1 box C. The rules are that in column D, where you enter proceeds, if you did not receive a Form 1099-B or 1099-S or substitute statement, enter the net proceeds from the sale. The net proceeds equal the gross proceeds minus any selling expenses such as broker's fees, commissions, and state and local transfer taxes. If you received a Form 1099-B or 1099-S substitute statement, enter the proceeds sales price shown on the form or statement that you received. If there are any selling expenses or option premiums that are not reflected on the form or statement that you received, enter a code E in column F and the necessary adjustment in column G. So it used to be in the past that IRS wanted you to enter the gross proceeds as the gross amount received from the sale and any selling expenses that you had added to basis. Nowadays, IRS is saying, no, we want you to enter the net proceeds. But if 1099-B has a number different than the net proceeds, enter an E to explain the difference or to explain why you have expenses. E stands for expenses. And then the amount of the expenses in column G to adjust down the profit. Next, we have column E, which is where you enter cost basis. If the property you sold was a covered security, its basis should be shown in box 1E of Form 1099-B. This is the amount that you would then enter in column E. But if the cost basis was not reported to the IRS, then enter your actual cost basis. So what this is saying is if you receive a 1099-B, no matter what the number is that's on the 1099-B that is listed as cost, you enter that as cost on the 8949, even if the cost shown on the 1099-B is wrong. But if you receive a 1099-B and it doesn't have cost shown on it, or if the cost is not reported to the IRS, then you would enter the actual correct cost in column E. And then we move on to column F and G. If the gain or loss reported to the IRS is not correct, use columns F and G to describe differences between the gain shown on your return and the gain reported to the IRS. Enter the reason for the difference in column F and then the amount of the adjustment you are claiming in column G. If you did not receive a Form 1099-B or a 1099-S substitute statement for the transaction, report short-term gains or losses in Part 1 and long-term gains or losses in Part 2. Enter the details of each transaction on a separate line of Form 8949 and use as many forms as you need. Now, for Box A, you check this box for short-term transactions that are reported on Form 1099-B and the basis is reported on the 1099-B. If your substitute statement shows cost or other basis for the transaction but indicates it was not reported to the IRS, report that transaction in Form 8949 with Box B checked rather than Box A checked. All right? And then for Box B, check the box for short-term transactions reported on Form 1099-B or a substitute statement without an amount shown for cost or other basis. If your substitute statement shows cost or other basis for the transactions but indicates it was not reported to the IRS, report that transaction in Part 1 of Form 8949 with Box B and not Box A checked. And then finally, for Box C, check box for short-term transactions that were not reported on Form 1099-B or a similar statement. Now, you should include on each Form 8949 only transactions described in the text for the box that you checked, A, B, or C. If you have an A and a B, or if you have a B and a C, you would do a separate Form 8949 for each category of transaction. You would check only one box on each 8949. For example, if you check box A in Part 1 of one Form 8949, include on that 8949 only short-term gains and losses from transactions that your broker reported to you on a Form 1099-B or a similar statement showing that the basis was reported to the IRS. If you have other types of transactions, report those on a separate Form 8949 and check the box that applies. And when we move over to Part 2, for long-term sales, all of the same rules apply. Just this long time, the holding period would be long-term. And I'm going to be showing you some 1099-B substitute statements in just a moment that are really modeled on or copied based on what I'm seeing these reporting agencies doing. But the reporting agency, if it has issued a document that says these sales transactions are long-term transactions where basis was reported to the IRS, that tells you you're going to check box D. And it'll even say report these amounts on Form 8949 line 1 with box D checked. They'll usually say that. Then you could have another statement that says these sales amounts were reported to the IRS, but basis was not reported. Report on Form 8949 with box E checked. Or you could have no 1099-B at all. You've just sold something outright. There's no 1099-B that is issued or ever will be issued. And then you would check box F. So let's look at these columns in turn. In column A, you're going to enter the description of the property, and the description of the property would come over from box 1B on the 1099-B. The date acquired in this column, enter the date that you acquired the asset. However, if you inherited the property, write the word inherited in column C rather than the date that you acquired the property. For sales of property, if you sold a block of stock or similar property that you acquired through several different purchases, you can report the sale on one line and enter various in the purchase date column. So it's possible to have the word inherit in the purchase date column, and it's also permissible to enter the word various in the purchase date column if you sold a block of stock all at one time on the same day, but the dates you acquired the stock varied over time. However, you must still separate all of the stock into either long-term or short-term categories, and you couldn't lump long-term and short-term stock all sold at one day on the same transaction into one category. So most 1099-B statements these days will show you that you might have sold several blocks of stock. Maybe you own ABC stock and you've been acquiring it over the last 10 years. And you sold all 1,000 shares you have in ABC stock at one time. But you were in the habit of purchasing 100 shares of ABC stock every year for 10 years. And so the most recent year of purchases would probably be short-term, and all of the other years would have been held long-term, but ultimately you have 1,000 shares of stock that were sold at one time. Because they were sold at one time, you can just enter one line. ABC stock, the date acquired would be various, and the proceeds would be the full sales amount, and then the date sold would be the date you sold them all on. But if you've got 100 shares out of 1,000 shares that are actually short-term, then you have to move those over to the line 1A or line 1B of the form. You wouldn't keep them in with the long-term amounts. Now, the opposite is not permissible, though. Let's just say on one day you purchased 1,000 shares of ABC stock and then you decided to sell it on separate dates. You cannot ever have various entered in the date of sale column. So you are allowed to block sell and block report the sale of stock, but you are not allowed to report as if it was a blocked sale assets that were purchased even on the same day and then report them as a single sale on various days with the word various in the sale. So whatever date you sell, even if you sell only part of the stock, you're going to have to break that stock sale down into the amount sold on each date. Cost or other basis of property. In general, the cost or other basis is your cost in the property plus purchase commissions and improvements and minus depreciation, amortization, and depletion. For gifted property, the basis of the property acquired by gift is generally the basis of the property in the hands of the donor, and an exception to that is if the fair market value on the date of the gift is less than the basis. Inherited property. The basis of inherited property is generally the fair market value at the date of death. Covered security. If the property you sold was a covered security, its basis should be shown in Box 1E of Form 1099B that you received from your broker. If the basis on the Form 1099B is not correct, make an adjustment to correct the amount of gain or loss you are reporting in column G, and then enter the appropriate code to describe the reason you are making a correction. For a non-covered security, if Box 5 on the 1099B is checked, then the property sold was not a covered security. Enter the basis on Form 1099B in column E, and if no basis is shown on Form 1099B, enter the correct basis of the property in column E. Column F code, well, there's a variety of codes. I'll show you those in just a minute. And then column G is where you enter your adjustment to the gain or loss. If you have an adjustment to the gain or loss, you would enter a positive number in column G to increase the gain or reduce the loss that is shown in column H, and you would enter a negative number to reduce the gain or to increase the loss. Enter negative amounts in parentheses. Also, enter a code in column F to explain the reason for the adjustment. And unless you reported the net sales price in column D, include in this column G any expense of the sale, such as brokerage fees, commissions, state and local transfer taxes, and option premiums. And if you have more than one code to enter in column F on the same line, enter the net adjustment in column G. And if one adjustment is 5,000 and another is negative 1,000, then you would average those out and enter 4,000. So here are the codes that I was mentioning. These come from the instructions for Form 8949. I'm not going to read through them all for you, but I'm going to point out the ones that kind of leap out as me. The one that I use almost every day of the tax season is Code B. You received a Form 1099B or substitute statement, and the basis shown in Box 1E is incorrect. It is incorrect all the time. You know, for example, that it is incorrect if you're dealing with employee stock purchase plans. And you know it's incorrect if there is a code W on there for a wash sale. But if there is a code W for a wash sale, you would not use a code B. You would use a code W. So let's move on to the next ones. If you sold or exchanged your main home at a gain, you must report the sale or exchange in Part 2 of Form 8949, and you can exclude some or all of the gain. If you can, then you would enter a code H. And then here is code W. If you have a non-deductible loss from a wash sale, enter code W. If you have a non-deductible loss other than by a wash sale, enter a code L. And an example of a non-deductible loss is the sale of property between related persons. If you want to see other ideas or examples of non-deductible losses, look in the instructions for Schedule D. And then finally, code E, if you received a Form 1099B or 1099S for a transaction and there are selling expenses or option premiums that are not reflected on the form or statement by an adjustment to either the proceeds or basis that are shown on the form, then you would claim an expense amount for the expenses not already subtracted out of the sales proceeds. You would enter code E in the column. Form 8949 not required. So we've been talking about Form 8949, but not all sales are required to be reported on that form. Most sales that you would typically deal with as a tax preparer, especially stock sales, are going to get reported on 8949, but there are exceptions to this rule. Exception number 1 is that you can attach a statement in lieu of Form 8949. Instead of reporting each of your transactions on a separate row of Part 1 or Part 2, you can report them on an attached statement, so long as that attached statement contains all the same information as Part 1 and 2 and in a similar format. Do not enter available upon request and summary totals in lieu of reporting the details of each transaction in Part 1 or Part 2. So essentially, there's a couple of different ways you can go about doing this as a tax professional. And if you've got a client, and I do have them, where they literally have hundreds of transactions and then they're full of wash sales, sometimes you're making a decision about where is that line between listing every one of these out manually and saying, oh my gosh, is there a way around listing all of these manually? IRS says you need to list them all, but if you don't want to enter them all into the software individually, you can attach a separate statement and mail that to the IRS, and you would actually do that. It's permissible to do that with a form called 8453. Form 8453 is an attachment form. You're electronically filing a tax return, but there are documents that you need to get to the IRS that are not going to go out electronically. And so you attach them to the Form 8453 and mail that in separately. And what you attach to Form 8453 needs to contain all the same information that the 8949 would have asked for and in a similar format. It's possible your client has delivered it to you that way, and that would be a way around doing all the data entry. Now, there are all different kinds of software options out there. Some software programs have import formats that allow you to import Excel spreadsheets. So Drake software does allow for some importation, but it takes a certain amount of time to set spreadsheets up for importation. I have a kind of a line where if I see a certain number of transactions, I'm just going to enter them manually. It's easier than doing the import, but there comes a point where the import is the way to go. Exception number 2, corporations and partnerships meet certain criteria. If you are filing Form 1120-S or 1065 and you are an organization exempt from receiving a Form 1099-B, such as a corporation or exempt organization, you may enter summary totals instead of detailing each transaction on a separate row if you are reporting more than 5 transactions on a part of Form 8949. And finally, exception number 3, you qualify for aggregate reporting. Well, aggregate reporting was the call of the tax professional for a long, long time. Is it really necessary to manually enter all of these transactions? It seems redundant and ridiculous to have to do this. And finally, the IRS, you could say, heard the call to action and did, beginning with tax year 2013, allow for some aggregate reporting. And I've used this aggregate reporting now for 2 tax seasons, and I can tell you it is definitely saving me time and saving my clients money as a result. I have one client who has a reasonably complex portfolio in terms of the number of transactions going on in it. She has multiple accounts, and each account had, sometimes hundreds of transactions in it that I had to go through and then balance all out. And with this new rule for aggregate reporting, what I'm now looking at on her 1099-B statements is to see that basis is reported for every transaction and that there are no wash sales. If basis is reported on every transaction and there are no wash sales, instead of entering every single sale from that 1099-B, the only thing I need to do is enter the summary totals on line 1A or 8A, depending on whether they're long-term or short-term. So her bill dropped by about $400 over where it was a couple of years ago because I was able to do this aggregate reporting. But unfortunately, because of the wash sale rule and because she has employee stock purchase shares that she's exercising, it's not possible to do this on all of her transactions, and I'm still forced to do an extensive amount of manual computations because the basis reporting is not always correct on all statements. So aggregate reporting is allowed only for transactions other than the sales of collectibles for which you received a Form 1099-B or substitute statement that shows basis was reported to the IRS and does not show any adjustments in box 1G. And you do not need to make any adjustments to the basis or type of gain or loss, that is short-term or long-term, reported on Form 1099-B or a similar statement or to your gain or loss. If you choose to report these transactions directly on Schedule D, you do not need to include them on 8949, and you do not need to attach a statement. You should see Schedule D instructions for more information. For e-file, if you e-file your return but choose not to include your transactions on the electronic short-term capital gain or long-term capital gain or loss records, then you can attach these transactions to Form 8453 and mail them to the IRS. Schedule D, capital gains and losses. Schedule D was significantly changed for 2011 and later years, and many transactions that in previous years would have been reported on Schedule D must now be reported on Form 8949 instead. And you must complete Form 8949 before you complete lines 1B, 2, 3, 8, 9, or 10 of Schedule D. Now, it is possible to use Schedule D without completing Form 8949, and you also have to use Schedule D when you complete Form 8949 and in a variety of other situations as well. So this paragraph right here is talking about when you are required to file Schedule D. You're going to use Schedule D to figure the overall gain or loss from transactions that you are entering on Form 8949, and to report certain transactions that you do not have to report on 8949. Also to report a gain from Form 2439, 6252, or Part 1 of Form 4797, and to report a gain or a loss from 4684, 6781, or 8824. 8824 is like-kind exchange. 4684 is, I think, casualty loss. 6252 is installment sales. 4797 is long-term capital gain income from sale of business assets. So all of those still carry to Schedule D. To report a gain or a loss from a partnership, S corporation, estate, or a trust, you also need a Schedule D. And to report capital gain distributions not reported directly on Form 1040, line 13, you will need a Schedule D. You'll also use Schedule D to report a capital loss carryover from 2013, 2014, and you can use the form to report transactions for which basis reporting on Form 1099-B is correct. So I talked about aggregate reporting of stock sales already. Let's move on to the Schedule D, where you can see on line 1A it says totals for all short-term transactions reported on Form 1099-B for which basis reporting was correct and which you have no adjustments. If this is you or this is your client, then you can enter the sum totals of the amounts reported on 1099-B into line 1A without having to enter each transaction separately. But as soon as any of the basis amounts reported on 1099-B are incorrect, or if basis is not reported on 1099-B, then you're going to have to do 8949, and you're going to have to complete the correct 8949 for the type of sale you have. So line 1B is for short-term sales where basis was reported to IRS. Line 2 is for short-term sales where basis was not reported to IRS. And line 3 is for short-term sales where no amount was reported to IRS at all. For Part 2, on line 8A, you'll report aggregate sales amounts for which basis was accurately reported to IRS. No 8949 is required for those sales. You'll use 8B to report long-term transactions where basis is reported to IRS. Line 9B where basis is not reported to the IRS, and line 10 where no sale amount was reported to IRS at all. On line 11, you're going to report any gain from Form 4797 Part 1, long-term gains from Form 2439 and 6252, as well as long-term gains and losses from 4684, 6781, and 8824. And 8824 is like-kind exchanges. Then on line 12, you'll enter your net long-term gain or loss from partnerships, S corporations, trusts, and estates. Line 13 is for capital gain distributions. Line 14 is your long-term carryover from the earlier year. And I can see that we're at the top of the hour and probably ready for our next break. So when we get back from the break, I'm going to go into a very detailed illustration for a character named Jake Edwards. And so let's take 10 minutes. I'm going to give you your next password of the day, and while we're on break, I might throw another couple of C questions up at you for entertainment purposes. Password number 2 is FOAL, F-O-A-L, FOAL. Okay, everyone, welcome back from break. I put a C question up on the board for you to think your way through over the break, and I'm pleased to say that all of you who answered got the correct answer. The question is, allowable loss or carry forward on stock sale. Bob sold securities in 2014, and the sales resulted in a capital loss of $7,000. He had no other capital transactions. He and his wife, Gloria, decide to file separate returns for 2014. His taxable income was $26,000. What is the amount of capital loss that he can deduct on his 2014 return, and what is the amount of carryover for 2014 into 2015? And I did do up a pod to explain this answer. And, of course, when we're figuring the answer to this problem, what we need to do is determine what the loss amount is. The loss amount is $7,000 total, and he is allowed to claim $1,500 of that loss because he is married filing separate. And that means that $1,500 is allowed out of $7,000 and that the loss carry forward is $5,500. All right, so we are going to pick up after this break by looking at a very detailed illustration. This illustration is pretty much as real life as I can make it because the tax documents that I'm going to be showing you, they are tax documents that belong to real people. I just took their names off and changed a few things, but essentially this is what the tax documents look like that my clients are walking in the door with. We service a lot of Intel clients, and so it's common for me in my illustrations to show reporting statements that are provided by Intel. But you should not expect in any way, shape, or form that the reporting documents you look at are going to be the same. In fact, they won't be the same. They're going to look completely different. What's important is that you recognize when you need the information and that you're able to recognize that information when it's sitting in front of you. Most clients do not know enough to bring this information until you ask them for it. After doing Intel employees for so many years, I can tell you that the majority of them who have come to me for a few years know exactly what they need to bring. And even then, they still manage to miss a few documents. But people who've never been to me before usually come in completely empty-handed. And one of the things that I know is that employees have the ability to log into accounts as employees, and that when they log into those accounts, they're very often able to access the documentation that I need. This would not be exclusive to Intel employees. It would be fairly common in the modern world that particular tax client you have who is working for a company and receiving stock options through that company is going to be able to log on somewhere and see what the dates were that the options were granted, what the dates were they were exercised, what the dates were that they sold, how much they paid, how much they received, how much was grossed up on the W-2. This information is going to be provided somewhere, and it's just your job to make sure that that information is delivered to you. Some clients are pretty resistant about it. I've had clients who just don't know why I need this information. They're annoyed that I'm asking for the information and are even sullen or sulking over the fact that I need this information. And sometimes I wonder to myself, why am I trying to help this person? But the fact that they don't understand why I need the information doesn't mean that I should ignore the fact that I need it, and I typically keep hammering at them until I get it. Sometimes I have them sit down in my office. I say, here's the keyboard, log on, and let's find it together. And then we print it out while they're sitting here. I'm able to do that with some, but not all clients. So let's take a look at this as realistic as I could make it illustration, which is reasonably complex. It's involving preparation of a Form 1040, a Schedule A, a Schedule B, a Schedule D, Form 8938, Form 8949, and FinCEN Form 114. My goodness, a lot going on there. Jake Edwards is married to Mary, and she is a homemaker. Jake is an engineer at Intel Chip Inc., and he and his wife were covered by health insurance throughout the year by his employer. During the year, he sold non-qualified stock options. The sale of the options was reported through UBS Financial Services. Jake's UBS Form 1099-B and UBS Intel Advice of Exercise in his W-2 are attached. Jake inherited stock from his father, who was a resident of the United Kingdom. His stock remains invested in Barclays of London, and the year-end value of the account was £100,000, and the maximum value of the account during the year was £125,000. The U.S. dollar, UK pound sterling exchange rate that we're applying for this illustration is 0.6410, which means the maximum account value during the year was actually $195,008 U.S., and that the account issued 6,173 pounds of qualified dividends, $9,630 U.S. equivalent. He did not sell any of his shares during the year. Jake also maintains a savings account with UK national banks. The account generated $500 U.S. of interest income during the year. The year-end balance and highest balance of the account was $15,000 U.S. for the year. Jake paid £64 or $100 U.S. of foreign tax to the United Kingdom on his interest income. The Edwards sold stock and property during the year in the following transactions. They sold some stock holdings through Edward Jones. Their consolidated 1099 statement is included for use in preparing the Edwards return. And they also sold Intel stock options acquired by Jake through an employee stock option plan. An advice of exercise notice issued by Intel is included along with a substitute 1099-B statement from UBS. And they also sold some vacant land that was purchased on 1/1/2000. The land has an adjusted basis of $20,000 and was sold on 10/3/14 for $100,000. The Edwards have a long-term capital loss carryover of $5,000 from 2013. Let's prepare their tax return. So let's start by studying the tax documents first. And the first document that we're going to look at is the 1099-S. And on the 1099-S, we can see that there was a sales proceeds from the sale of land for $100,000. And down here we see buyer's part of real estate tax, $500. We're not treating this amount as taxable. We can argue for the sake of this exercise that it is not taxable, but we should be aware that $500 was refunded to this particular filer, and if they made a payment out of $4,000 of property tax for the year and then got refunded $500 at close, then their deduction would be limited to $3,500. But at any rate, we haven't been itemizing for them, and so there's no impact from this $500 amount. Or at least we're not itemizing on these numbers. All right, consolidated 1099 statements. This is how they look these days. And they don't look anything like the IRS formats. The IRS has its formats and instructions on how to complete those forms, and then no one uses them. So it's just best as well to get used to looking for information in whatever way a particular brokerage house decides to give it to you. In this particular one, we're looking for some information. It says this important tax information is being furnished to the Internal Revenue Service. If you are required to file a return, a negligence penalty or other sanction may be imposed upon you if this income is taxable and the IRS determines that it has not been reported. So up here it says includes 1099 INT, 1099 DIV, and 1099B, and that this is a consolidated statement. So essentially 3 different 1099s are all being reported on one statement at the same time to the IRS and to the taxpayer. When we look at the 1099 INT, we can see that there's numbers in box 1 and box 8. Box 1 represents ordinary interest income, and box 8 represents tax-exempt interest income. So to begin, I'm thinking mentally, all right, well, box 1 is going to go on line 8A of the tax return, and box 8, tax-exempt interest, will be going on line 8B of the Form 1040. We then go over to the 1099 DIV, and it shows box 1A, ordinary dividends of $3,282. This is the amount that's going to get reported on line 9A, and then we can see that there's qualified dividends of $959 or $960 rounded, and I know that that's going to get reported on line 9B of the 1040, but more importantly, this qualified dividend amount is going to be eligible for lower capital gain treatment. And we can see box 2A has $3,669 being reported on that line. That is going to carry over to the Schedule D unless it's possible to enter the amount directly on the Form 1040. Well, as soon as Schedule D is required for any other reason, I will no longer take the number on 1099 DIV box 2A and enter it directly on Schedule, or not on Schedule, but directly on the 1040. If I were to enter it directly on 1040, it would go on line 13. But because we're going to get there, Schedule D is otherwise required, this number is going to carry over to the Schedule D and get entered on line 13 of Schedule D. We move down the 1099 DIV, and we've got an amount in box 10. This is for exempt interest dividends. These are dividends that are essentially attributable to state bonds or territorial bonds, say the U.S. territories like Guam or Puerto Rico, those types of U.S. territories. And interest issued on those types of bonds is not taxable. So if it's a U.S. state or a U.S. territory, interest that comes off those bonds is not taxable. And this, too, would carry to line 8B of the Form 1040. And then we have an amount in Box 11, Specified Private Activity Bond Interest Dividends, $117. What's relevant about a number in Box 11 is that as soon as you see a number in Box 11, your mind should be thinking alternative minimum tax. Box 11 is included in Box 10, just as Box 1B is included in Box 1A. So Box 11 is merely telling you that Form 6251 may possibly need to be completed, and if it does need to be completed, this amount of income, although it is exempt from income tax under the regular tax, is not exempt from the alternative minimum tax and would be added to AMT income. Moving on to the next page, we're now on to Form 1099B, and it's important with Form 1099B to look at each heading on the 1099B to know what it is that you're looking at. This particular heading says short-term transactions for which basis is reported to the IRS. Report on Form 8949 Part 1 with Box A checked. Then it also tells you that this is short-term gains that are covered. Short-term Box 2, covered Box 3. So it's not showing you a 1099B with a checkbox in Box 3. It's just telling you that it's covered in Box 3 is essentially checked, even though you're not looking at a checkbox, right? And then we look at the description. We can see that this particular brokerage statement has 2 sales. A particular client might have 2 sales, 1 sale, 50 sales, 100 sales. What's important is that if the basis was reported to the IRS, we have a number reflected here that can be entered directly on Schedule D. An aggregate total could be carried directly to Schedule D without first being reported on 8949. And to determine if we can aggregate report these 2 amounts, we're going to look for adjustments. And we don't see any adjustments in Box 1E, and we do see that basis is showing in Box 1E. And assuming this basis amount is correct, then it means that we will be able to report these aggregate amounts directly on Schedule D. They will carry to line 1A. Sales amount will be entered on column D of $19,621, and the basis amount will be entered on column E of the Schedule D in the amount of $21,469. Moving on to the next 1099B, this one says long-term transactions for which basis is reported to the IRS. Report on Form 8949 Part 2 with Box D checked, and it is long-term checked in Box 2, and it is also covered. But this time around, we have a problem. We're dealing with 3 different sales. We have 1 sale of Calvert, and we have 2 sales of Franklin. But on this second sale of Franklin, you can see that there's a code W with an adjustment of $6.25. We're done. There's no aggregate reporting allowed for this particular 1099B. We're going to have to enter all 3 of these transactions on Form 8949, and we're going to fill out Form 8949 Part 2 with Box D checked. You can see where it says Box D checked right there. Moving on, we now have another 1099B. This one says long-term transactions for which basis is reported to the IRS on Form 8949 Part 2, but check Box E. So now we're supposed to check Box E, not check Box D. And in this case, we have 1 sale amount, $30,147. We can see that the acquisition date is various, and essentially, although they are reporting basis on the document, they're telling you that it's not a covered transaction. So it's a non-covered transaction this time. Box 5 is checked rather than Box 3, and because it's a non-covered transaction, we're going to fill out 8949 with Box E checked. And then the next one we look at is not a 1099B. It's a total from the 1099Bs. And what I like to do, and actually I make it a policy in our firm-wide for our company, Pacific Northwest Tax Service, is that we ask all of our employees to do some form of reconciliation against all of the 1099B totals. Now, for Jake Edwards, the brokerage firm, Smith Barney, has actually done a consolidation of all of these different 1099 amounts. It's showing us that there's the total short-term covered amounts are $19,000, and the cost basis on those is $21,000. It's showing us these total amounts. And it's doing the same thing for the long-term, but it's showing total long-term non-covered totals plus total long-term covered totals. And then it's got the total of all of these all combined. And I like to do this with multiple 1099s. So So, for example, this particular 1099 has totaled itself, which is very nice. But what if my client has multiple 1099s? The one 1099 is not going to know about the other. And so I actually start either handwriting out a multiple 1099B totals. This is the cost amount from this set of 1099Bs. This is the sale amount from this set of 1099Bs. I'll do that for each set of 1099Bs I have and just do a total. And then what I look to see is when I finish preparing the Schedule D that my manual totals for each box checked are an exact amount to the amount on the tax return. And it is usually the case on the first try they're not. Usually the case that there is a misbalance, not because of my hash totals that I'm doing by hand, or you might do it on an Excel spreadsheet somewhere, but because somewhere in the software I have a data entry error, and I need to find that data entry error. So I usually find it's best to enter the 1099Bs one at a time. So if you've got a 1099B, for example, that has 20 transactions on it, and then you've got another 1099B right behind it with another 30 transactions on it, I'll enter the first 1099B and get it to balance perfectly in the software. Once I know that it's balanced perfectly in the software, then I don't need to worry about it anymore, and I go on to the next 1099B and I start entering it. And if I don't have a perfect balance after I'm finished entering the second 1099B, then I know the reason I don't have a balance is because of an error on the second 1099B. But if I don't check or balance my entries as I go through each 1099B, then I could enter 4 or 5 1099Bs and have no idea which one has the error. Is it 1, 2, or a combination of all of them that have an error? So balancing as you go is just a good methodology to use. Now, it is possible to do all of this balancing ahead of time on a spreadsheet and then import the spreadsheet. Quite frankly, for me, it just boils down to how many transactions on how many statements, which method I'm going to ultimately use. But this year, because so many of the aggregate reporting amounts were correct, and because there were some improvements to the software I was using, I found it was actually a lot easier to enter manually and catch my errors than it has been in the past. And so I didn't do as many spreadsheets for import this year as I have done in the past. Moving on to the next page. It is normal for consolidated statements from brokerage houses to give you additional pages. And these additional pages contain valuable information. Very often at the state level, they're important. Maybe not at the federal level, but at the state level, they're certainly very important. And so I threw some examples in here of these supplementary statements just so that if you are new to tax law or you're not really experienced with dealing with these forms, that you at least understand when you're looking at a supplementary statement and when you're looking at the actual 1099B. You can see here that we have a heading that says this is not a Form 1099B. It is a summary of the information you received in your account during the year. For a complete description of each activity, refer to your account statement for that period, and if you have any questions, contact your Edward Jones financial advisor. So I said Smith Barney earlier. This is actually Edward Jones here. And so what it's doing is it's showing you all of the different interest amounts and the dates that they were accredited to your account, and that's the $1.42. Well, this $1.42 matches or balances to the 1099 INT form that I showed you earlier and explains when those interest amounts were paid. Now, if I were doing a multi-state tax return for a person who moved from one state to another state, this information would be of concern to me for determining how much interest would be taxable in the old state and how much interest income would be taxable in the new state. Then we move over to the tax-exempt interest. Well, tax-exempt interest means tax-exempt at the federal level only. It doesn't mean tax-exempt at the state level unless the interest is based on a bond issued by your home state. So if you're a resident of California and you're filing a California return and you've got Boulder, Colorado exempt interest, well, it's going to be exempt on the federal return, but I'm already looking at numbers here which have nothing to do with California. So they're obviously going to be additions to income on the California return, and these are all Colorado bonds. Exempt from federal tax, but not exempt from state tax. So if we go back up, and I don't even remember what I told you Jake was a resident of. I think I did say California. We're looking at the 1099 INT, and you can see there's $1,512.50 of exempt interest on box 8. And then on box 10, we have another $1,500 of exempt interest dividend income. Well, these are exempt at the federal level only. And when we get down to the state level, we're concerned about what portion of those bonds are going to be exempt at the state level. And that means moving over to these back statements. The information contained in them is not given to the IRS. The IRS could care less about it, not interested. At the state level, it means everything, though. And at the state level, we're trying to determine what, if any, of this interest is going to be exempt from state taxation. And in this case, if we have a California resident, none of this $1,512 is exempt from the state taxation, and it will be in addition to income. We then move over to dividend income next. And we can see the first listing is for total qualified dividends. This qualified dividend distribution date can be relevant, again, if you're moving from one state to another. So if you start the year in Oregon and then move to California, when you get these dividends is going to dictate how much is going to be taxed at each level. We can see that the first dividend, qualified dividend income, wasn't issued until October, late October. So we have American High Income Fund, we have Calvert, we have Franklin. So it's showing these funds in alphabetical order and the dates that qualified dividends were paid out. And we can see that there was nothing paid out in the first half of the year. So if you moved, on May 1st, then it would be safe to say that the old state gets to tax none of it and the new state gets to tax all of it. Moving on to the next part, we continue going where we've got dividend income. And essentially it shows us all of the total capital gain dividends. And then it also shows us the tax-exempt dividend income, and it continues on to the next page where we've got more and more tax-exempt dividend income. Finally, down here, we've got the total on our tax-exempt dividend income. Now, we're finished with all of that, and we're moving on to yet another 1099-B. And this one is not coming from Edward Jones. This one is coming from UBS. It happens to be UPS is the brokerage house of choice for people who have Intel stock, so I see these ones all the time. But how do we know what we're looking at? It's a UBS 1099-B, short-term transactions for which basis is reported to the IRS. Report on Form 8949, Part 1 with Box A checked. We can see that there was no federal tax withheld, and Box 3 is checked, meaning basis was reported to the IRS. Here we look and we have a quantity of 500 shares of Intel chip, date of acquisition and date of sale. And we can see that it's a same-day transaction. And immediately that should send the warning flags going because we have proceeds of $13,121 and a cost basis of only $9,500. Well, how do you make that much money in one day, in 1 hour, or however long this employee held this stock for? Right away, I know that this basis is wrong. I don't need to take a step further because this is just too much gain for a single day unless something really wacko happened on the stock market. So I know ahead of time that I'm dealing with an employee of Intel chip, and I know probably that this is a compensatory option. And let's determine if it is a compensatory option. One of the things to look for is that Jake has a W-2, and his W-2 shows a code V. And I'm trying to think, did I show you his W-2? Looks like I didn't throw it in here, so that's confusing for you. I should have had his W-2 in here. At any rate, I'm going to tell you verbally that he has a W-2. And when you look at the W-2, there is a code V in box 12. And the number next to that code V is $3,621. Well, it happens to be if you take $9,500 and subtract it from $13,120, that's where you get $3,621. So I've got now two clues. I've got a W-2 with a code V and $3,621 in box 12. And then I also have a 1099-B showing that they made $3,621 in a day. So that tells me that the basis reported on this document is incorrect. It means I cannot report it under the aggregate totals on Schedule D. Rather, I'm going to need to complete Form 8949. I'm going to check box A because basis was reported to the IRS, and then I'm going to enter on the 8949 proceeds as they appear on the 1099-B, cost basis as it appears on the 1099-B, and then I'm going to go over to column G and I'm going to enter a code B to indicate that the basis reported was incorrect, and then I'll enter the adjustment, which would be negative $3,621. Moving on to the next document, this is an evasive exercise. This is the type of document that tax clients should be bringing to you anytime they have exercised employee stock purchase plan shares or anytime they have exercised non-qualified options. In this particular case, it's an NQO. And it even tells you that right here, NQO, non-qualified option. It shows the grant price, the option exercise cost, the fair market value, the sales price, the total sales proceeds. It happens to be that these sales proceeds amounts are a match to what's on the 1099B, but the 1099B is accounting for the brokerage fee. So we have a total gain of $36.21. This is the amount that they received as sales proceeds. If the 1099B has a different number, which sometimes is the case because there are brokerage commissions being held out, then there may be a small adjustment. The bottom line is that when you're dealing with employee stock purchase plan sales and NQO sales, you should be expecting to see a small loss on the disposition of the stock. So let's move over to his 1040 return, and when we get to the 1040 return, we start with line 8A where we enter the total amount of interest received. He had a 1099B showing $1.52 of interest. We're going to round that up to $2. And then he also had $500 of interest he received off his United Kingdom bank account. So we add those two numbers together. That's where we get 502. Then he had some tax-exempt interest income. We showed you that he had tax-exempt interest on line 8 of his 1099 INT and on line 10 of his 1099 DIV as well. Then on line 9A, we're showing ordinary dividend income. And this is greater than the amount reported on his 1099 DIV because he also had Barclays of London dividend income totaling $9,630. So really all of these amounts for interest and dividend income, excluding the tax-exempt interest amount, but the ordinary interest and the ordinary dividend amounts, those are appearing on the Schedule B. And then from that Schedule B, the ordinary dividend amount, we need to determine how much is qualified dividend. And we know that he held the stock long term, so the dividends he received on it are going to be qualified dividends. Then we move on to page 2 of the form, and we can see after we figured all of his taxable income, we arrive at a taxable income figure of $195,411. We're going to have to complete the qualified dividend and capital gain worksheet to figure the amount of tax to enter on this line. It's ultimately going to be $31,833, but I'll show you how we compute that. His W-2 had some withholding for income tax, $13,956. We haven't given him any other itemized deductions, just trying to keep what's already a complex problem a little bit simpler. But here is the Schedule B. We have Edward Jones showing a 1099 INT with $2 of interest, and then that UK National Bank of $500. And then Barclays of London paid $9,630 of dividend income, and Edward Jones paid $3,282. We also have to complete Part 3 of Schedule B to indicate that there was foreign ownership of foreign financial accounts. And so it says on line 7A, at any time during 2014, did you have a financial interest in or a signature authority over a financial account, such as a bank account, securities account, or brokerage account located in a foreign country? If the answer is yes, you need to check the yes box. And if the answer is yes, then are you required to file FinCEN Form 114? And you're required to file FinCEN Form 114 if at any time during the year the total value of your financial accounts overseas exceeded $10,000. And obviously for Jake they did. And so we're going to have to check yes to question 7B. And then it says if you are required to file FinCEN Form 114, enter the country where the financial account is located. And we've indicated that that is the United Kingdom. And then finally, during the year, did you receive a distribution from or were you the grantor of or transfer to a foreign trust? The answer is no to that question. Moving on to Schedule D. On Schedule D, we're entering the summary totals from his 8949s, with the exception of line 1A, where the Edward Jones statement reported amounts that were short-term covered with basis that was correctly reported. So for that very first 1099B from Edward Jones, we have total amounts that can be aggregately reported on line 1A. But for line 1B, this represents the sale of the Intel options, and we're going to show the amounts that appear on the 1099B, even though they're incorrect, and then we enter an adjustment for the difference. But this amount has to carry from Form 8949, so we're going to go complete Form 8949 and then come back to the Schedule D. And then we have capital gain distributions. These are carrying over from the 1099 DIV. $3,669. And in the wording of the problem, I told you that there was a $5,000 long-term loss carry forward. So we're entering that on line 14. So moving over to Part 3 of the Schedule D, we're showing total capital gains for the year are $74,230, of which $1,854 is a short-term loss and $76,086 is long-term gain. But let's go now and look at these Form 8949s. The first 8949 I'm showing you is for the sale of the Intel chip shares. We've checked box A. We've entered the basis amount and the sales amount that are showing on the 1099-B. We've entered B for incorrect basis. We've entered the amount of the adjustment, and ultimately we have a loss of $6. Most of these exercise of employee stock purchase share plans and non-qualified options should result in a small loss, so that negative $6 is what you should expect to see. We then go over to 8949 Part 2 for long-term transactions. We've checked box D because basis was reported to the IRS. If it weren't for that single wash sale transaction, we would have been able to aggregately report these on Schedule D. But because we have this wash sale, we're forced to manually enter every sale on the document. And so we've done that. And then we get the totals down at the bottom on line 2, and those carry over to Schedule D, and we enter those on line 8 is where basis was reported to the IRS. Line 9 is where basis was not reported to the IRS but was reported as a sale to the IRS, and line 10 is where nothing was reported to the IRS. Okay, so we've done the line 8 amount. And now we're going to move on to the second page of Form 8949. This time we're reporting long-term sales for which basis was not reported. These are non-covered transactions. Edward Jones issued a 1099-B and showed that the basis is reported on the 1099-B, but it was a non-covered transaction. And so we're still going to report it on line E of the 8949. And we carry that total over to Schedule D. Then moving on to the next 8949, we have this time vacant land. So in the wording of the problem, I told you that they sold vacant land, and it was $100,000 of proceeds with a cost basis of $20,000 and a gain of $80,000. And now it's time to do the qualified dividends and capital gain worksheet. And this is quite a bit of work to go through all of these numbers. The purpose of the worksheet is to differentiate between the types of capital gain income that you have and whether you're going to be subjected to 0% tax, 15% tax, 20% tax, 25% tax, or 28% tax on your gains. The starting point for the worksheet is your taxable income from the 1040, and then on line 2 it says enter the amount from 1040, line 9B. That is your qualified dividends. Then it says what is the income reported on Schedule D? $74,232. So the total income eligible for capital gain treatment for Jake Edwards is going to be $84,822, which is the sum total of his qualified dividend distributions and his capital gain income, $84,822. The next step is to subtract $84,822 from his taxable income, and when you do that, you get $109,589. And now we compare line 7 to line 8. The question is line 7 greater than or less than the amount for their filing status on line 8? And this time their filing status is married filing joint, so we're going to pull over $73,800. It tells you that their income, before we factor in any capital gains, is still above the 15% filing bracket. So even if they had no capital gain or qualified dividend income for the year, they would still have been pushed into the 25% bracket. This tells us that none of their capital gain or qualified dividend is eligible for that 0% capital gain rate. All of their capital gain income is going to be taxed at a minimum rate of 15%. So the next step on the form is to determine if their income is high enough to push them into the 20% bracket. Clearly, they fall below the 20% bracket. So ultimately, the $73,800 is going to get taxed at a rate of 15%. And the next step in here is to calculate the tax based on the 15% of $84,822 and ordinary tax rates on the remaining $109,589. On line 19, we figure the amount of tax owed on the capital gain income. So 15% of $84,822 is $12,723. We then move over to line 24 and enter $19,110. This is the amount of income tax owed on the ordinary income amount up here of $109,000. And then the next step is to add those numbers together. We add them up and we get 31,833. This is 19,110 plus 12,723, so that is the correct number. And this is the combined tax they owe on both their capital gain income and their ordinary income. The final step is to see how much tax would they owe if they didn't get any capital gain treatment at all. And this you would use the tax rate schedules to determine. And if you figured tax manually on $194,411, you would come up with ordinary income tax of $41,682. They are allowed the lesser of line 26 or line 25, and the lesser amount is line 27. So we shoot back all the way up onto the 1040 form and enter 31,833. Their W-2 did show some withholding. Ultimately, they have a small refund of $322. And just bouncing back to the Schedule D, of course, we've completed Form 8949 for lines 1B, 8B, 9, and 10, and pulled all of those corresponding numbers over. And we're not quite done. Because their foreign financial holdings are so large, Jake also needs to file Form 8938 and attach it to his tax return. On Part 1 of Form 8938, it asks for the maximum value of all of his depository accounts during the year. In U.S. dollars, we come up with $210,088. Then the form asks, where on your federal return did you report income from these accounts? He had $500 of interest income that he reported on his return, and he also had $9,630 of dividend income that he reported on his return. And here we tell the IRS what point on the form these were reported. And we can say, well, they were reported on line 8A and line 9A respectively, and that they were also reported on Schedule B, lines 1 and 5. We then move on to Part 5 of the form, where we provide detailed information for each foreign deposit and custodial account. This is where we indicate the type of account it is, the account number. Was the account jointly held? We're saying no. Was it open during the year? Was it closed during the year? We're saying no. What was the maximum value of the account during the year? And did you use a foreign currency exchange rate to convert the value of the currency into U.S. dollars? And then what was the currency that you traded, pound sterling? What was the exchange rate? 0.0641. Now, there is a continuation of this particular account in Part 5 onto page 2 up at the top. And then interestingly, it moves on to foreign financial assets, which are different than foreign financial accounts, and Jake doesn't have those. And then we have a continuation sheet for each additional account. He has to list all of that same information over again, which we have done. But wait, we're still not done. He still has to file that FinCEN form. And beginning with 2013, the FBAR report is now filed with FinCEN and is no longer mailed into the Treasury Department. And so this is done electronically. You can apply for status as an e-file institution with FinCEN. And so we're filing several dozens of these every tax season for our clients now. The way that you complete them is actually in a PDF format. You go to the FinCEN site and you fill out the form on their site, and then you save it. You're supposed to save a copy to your hard drive. And you can do that. And then the next year you could go back and open up that same copy on your hard drive and simply change the information up at the top from 14 to 15 for next year, say, and now you'll go through and make sure that none of the information for the filer has changed. Clearly, there would probably be a change in the balances, and those do need to get reported as well. So here is the end of the lecture part of today's class. We have a few minutes left in the day to do a classwork assignment together. I can see I haven't given you enough time to do the classwork assignment, so I think that I'm just going to read it to you and then pull up the answer key, and if we end up finishing a few minutes early, that will be okay, because you're allowed to have a 10-minute break for every hour. So the timing for the class actually ended up being close to perfect, other than the fact that I don't really give you a chance to work on this classwork assignment. So if you want to think through it on your own after the day is over, that's where you'll need to be. But for this assignment, it's a kind of a simplified version of Jake Edwards. I've taken out some of the complexity that I threw into Jake Edwards because I had the luxury of doing all the work for you. And in this example, I'm going to show you more of the fundamental elements of filling out a Schedule D and an 8949, because those are the only two forms I'm asking you to complete. But there's a little more complication here because it's all compensatory options that Sam is reporting. And so figuring out what his basis adjustments are going to be is the challenge of this particular problem. So let's take a look at the wording together. Sam Techman is employed by Chipmaker Inc., and during the year he sold RSUs and ESPP shares. The following documents are attached: a copy of Sam's year-end pay stub showing RSU and ESPP awards and options that were added to his income, a UBS consolidated 1099 statement showing gross proceeds from sales during the year, a UBS advice of sale notice showing the cost basis in RSUs sold during the year, and 2 UBS advice of sale notices for purchase of ESPP shares during the year. Prepare Sam's Form 8949 and Schedule D to report all his sales transactions on Form 8949, even if it is not required. I believe ultimately, based on the information here, it's all required anyway. So here we have 428 shares that were sold in Chipmaker. The acquisition date is 2/19/14. The sales date is about 3 days later, but we have this decent-sized gain in the middle. That tells me that we probably have to have a basis adjustment. Then we have 653 shares of Chipmaker Inc., various acquisition dates, and a sales date of 5/27/14. Here we have a gain as well. That one's interesting. We're going to have to look at it some more. Then we have another one with an acquisition date of 4/16 and a sales date about a month and a half later. And then finally, we have another acquisition of 258 shares with an acquisition date of August 19 and a sale 4 days later, again showing a gain. So let's move over and take a look at some other information I've given you. And this next piece of information in line is his pay stub. It's a pay stub for Sam Techman. And pay stubs can be pretty revealing. They help you identify what is really going on with a particular employee. And this one here, we can see that the base pay for this particular worker is $94,305 year to date. And then we have a code here, RST-STK unit. That actually stands for Restricted Stock Unit. It tells you that his pay was grossed up by $43,000 because of restricted stock. Another word for restricted stock unit would be RSU. He sold some RSUs, didn't he? Which RSUs did he sell, and how much did he pay for them? And then whereas a quick sale, well, a quick sale is going to be those ESPP shares. Sometimes I've seen W-2s where they actually describe them as ESPPs. I've seen other W-2s where they say quick sale. And here we've got $2,565.85. And then it goes on and shows a few other amounts in here as well. Moving on to the next page of the pay stub, there's some more information again. We can see quick sale DD amounts. These are after-tax deductions. This is basically showing you taxes that were withheld. Interesting stuff. And then we move on to the advice of sale document. And this particular advice of sale is showing multiple sales of RSUs. 1, 2, 3, 4, 5 separate RSU amounts in different sales dates. We have a vest date of 6/21/13 and a sale date of 5/27/14. Because this is an RSU, it was included in that employee's pay when they were awarded the stock or when the stock became vested. So we're not even going to see an income amount reflected on the 2014 payroll or the 2014 W-2 because these RSUs became vested in an earlier year and were included in income in an earlier year. The interesting thing is, and I can't really understand why, I would need to think about it a little bit more or study it a little bit more, but I can tell you that ESPPs and NQOs are amounts that get grossed up on the W-2 and they are considered to be compensatory and the basis is not reflected on the 1099-B. But RSUs are different because RSUs are an award of stock for services rendered and there is no amount that the employee physically pays for the stock when it is awarded. If I fulfill the terms of a contract, my employer is going to give me 100 shares of stock, and then they're going to withhold a certain number of shares to pay the taxes that I owe, gross my pay up, do the withholdings to pay those taxes, and I'm just left holding a certain number of shares. Whatever amount my pay was grossed up by when I was awarded those shares, that becomes my cost basis in the share, and that is the basis that does get reported to the IRS. So I should know, just by looking at this, that the basis shown here for these RSUs on the 1099-B is probably correct. But how will I know if it is? How am I going to figure that out? Well, I'm going to have to do some computations. Then I go over to the next advice of sale document. This one says it's an ESPP. Well, if it's an ESPP, I know it probably doesn't have the correct basis reported to the IRS. And then I have another advice of sale. This one's for another ESPP, and again, I can pretty be sure that basis probably wasn't reported to the IRS. So my goodness, that's quite a bit of work there. So let's pull up the answer key for this problem and work through it together. Now, what I've done for the answer key is I've taken each of those advice of sale documents and analyzed it and provided a description for what I'm seeing on those documents. So let's start with the UBS Financial Services 1099B, the substitute 1099B. The first thing that I wanted to pull out and point out to you is that this line in peach represents net proceeds from the sale of RSU units. There were sales of RSU units on 5/27 of 14, two different sales on that same date, 254 shares on each sales date, and the cost of those shares, or the net proceeds of those shares, was $10,973.64, and the amount shown on the 1099B is slightly off. It's a difference of $20, and since the sales proceeds reported to IRS are more than the amount Sam actually received, he will need to enter a code B in column B. And actually, if I'm thinking about this a little, there's a code E that could be used as well. But at any rate, for sure, he's going to have to make an adjustment for the reporting amount in the 8949. Now, moving on to the next page, let's take a look at that advice of sale form that was issued to him by UBS and his employer, because it's showing cost basis and shares sold for RSUs that were vested in earlier years. And we've got some that were vested over a period of time in 2009, 10, and 11. And how much has been reported as basis to the IRS? Well, we're going to add up all of these amounts, 145 shares sold, 254 shares sold, 254 shares sold. Then we have another 254 and 254 here. So the cost of the RSUs that were vested during 2012 totaled $12,174.22. And then we have cost of RSUs that were vested in other years totaling $15,541. And then in a separate line here, we have the net proceeds. The sales price of 653 RSU shares on 5/27 of 14, because we can see that we have 5/27, 5/27, 5/27, 5/27, 5/27. They all have the same sales date. The total proceeds from this batch that I've highlighted in yellow is $14,105.86, and the sales price from the 1099B is the same number. And we subtract out the cost basis of $15.41 we have a short-term loss of $1,435.54. And then on this batch over here, we have net proceeds reported by Sam of $10,973.64. The amount shown on the 1099B is slightly higher. The difference is $20. Then we move over to the ESPPs, and we can see by looking at his payroll stub, because it doesn't show up on the W-2, the ESPP shares are included in W-2 income, but they aren't indicated with a code V, so you can't really tell that ESPP is on a W-2 simply by looking at it and looking for a code V, because it isn't there. So instead you go over to the pay stubs to see if you can find information there. It's also possible that they were issued another reporting document, a 3922 document. They should have been issued that. And you can look for information on that form as well, but ultimately I prefer these advice of exercise notices if they have them. And here it shows you that it was an ESPP. It shows what they paid for it, what it was worth on the date that they bought it. And the difference between what they paid for it and what it was worth is what gets grossed up on their W-2. So the purchase price is 428 shares at $16,495 per share, or $7,059. But the fair market value on that date was higher, and the difference between the fair market value and what the employee paid becomes gross up on the W-2. So $1,831.84 is added to the W-2. That means the cost basis in those shares is actually $8,891.70. Now, if we look at the sales proceeds, we have sales proceeds showing here of $87.41 and net proceeds of $87.23. The difference, $17 plus 12 cents, was withheld to pay brokerage and transaction fees to UBS. And note that the cost of the shares is greater than the sales proceeds. This happens when the fair market value drops between the time of purchase and the time of sale. We move on to the next exercise, and down here we have a purchase price of $16.125 and a fair market value of $18.97. That means that the actual exercise price for the Sam Techman is $4,160, but the fair market value is $4,894, and the difference between those two numbers, $734, needs to be added to his W-2. So I've looked at two amounts that I know that needed to be added to his W-2 for the sale of ESPP shares, and the question is, did that happen? And the answer is, when we go look at the pay stub, we're going to see that it did happen. So when we go over to the pay stub, when we look at the ESPP sale from the first advice of exercise and the second advice of exercise, and we look at how much should have been grossed up, we can see that the exact amount that I think should have been grossed up was in fact grossed up. $2,565.85 is the amount that was grossed up. Now the RSUs, those are trickier, because the RSUs that he sold during the year are not the RSUs that were included in his income for the year. The amount that was included in his income for this year is other RSUs that were issued to him in 2014, and he didn't sell any of those. He sold RSUs from earlier years. And again, we're on to the next page of his pay stub, where it's just showing the tax withholdings that went on because of these stocks. Here is the Schedule D. We're showing all of the transactions that are being reported on line 1B, and they're all short-term, and they ultimately result in a loss. We had a sales price of $38,635 and a cost of $38,935. We actually do have a loss there, but the loss that we're claiming on the return is significantly higher. So here is the $89.49, and we're going to list each of these transactions in turn. First, we have 508 shares of Chip Maker, and these were RSUs. And we've gone through and looked at advice of sale documents, and we've determined that the total amount of cost basis in these RSUs is $12,174, and the net proceeds are $10,973. But there's a difference here, and that's $20. So we've accounted for that $20 on line 1. We then go over to the next item in line, which is 258 shares of Chip Maker, and this was from the sale of shares totaling $48.12 and $41.60. And we ultimately have a short-term loss on these of $82. The 1099B showed $41.60, which is $48.12 minus $41.60 is $6.52. But since the loss is actually $82, we're going to enter an adjustment of $734 in column G. We then go on to the next line, which is for 428 ESPP shares. So the first one up here, 258 ESPP shares, followed by 428 ESPP shares. We know that the basis reporting on these is automatically wrong. That's why we're upping the column G here. So here we have another ESPP sale, which is a greater loss than was reported to the IRS. And we're increasing the loss by entering negative 1832 in column G. And finally, we did have one single sale of stock where the basis was correctly reported and no adjustment is needed, and that was for the second block here of RSU shares. When we went through and analyzed all of the RSU transactions on the advice of sale form and compared those to the 1099B form, they were an exact match. And so no basis adjustment is necessary. So again, just to summarize, when I see ESPP shares, I know basis is incorrect. When I see NQOs, I know the basis is probably incorrect. When I see RSUs, it's been my experience that the basis reported is correct, even though all of them are compensatory in nature. So we'll see what 2015 holds out, whether they change anything on us again. Here is the Schedule D showing the net short-term loss of $2,885. And that's it. That's Sam Techman's tax return. And gosh, it's exactly 1 o'clock. So let me give you the final password for the day. So thank you for participating in today's class. I hope to see you again soon. Password number 3 is LEGO. L-E-G-O. LEGO. We hope you've enjoyed this tax education class. Pacific Northwest Tax School is approved as a CE provider by the IRS and the states of Oregon, New York, and Texas. We have been awarded the Quality Assurance Standard by NASBA and meet the CE requirements for CPAs in most U.S. states and territories. Tax clients demand knowledge and experience. Pacific Northwest Tax School provides the in-depth, practical education needed to improve your understanding of tax law and to meet the demands of the competitive tax preparation industry.